Good morning, everyone. It's not the morning for you, it's the afternoon, so good afternoon, everyone. Thank you. So, I hope you're doing well today. So, first of all, I want to check the sound, it looks like it's working okay. Can you hear me well? Yes, very good. So, excellent. So, I guess we're going to start class. So, today is a bit different because we have two classes, one in the morning and one in the afternoon. So we're going to proceed as usual. The only difference, I suppose, is that we'll make some longer breaks, right? Otherwise, it's going to be too tough. So this morning we have 3.5 hours. So I guess we're going to do a 15-minute break in the middle, somewhere in the middle. And this afternoon we have 2.5 hours. So we're going to do a 10-minute break somewhere in the middle. All right. That's the first thing I wanted to say. The second one is towards the end of this class. So we don't have class tomorrow, you know that now. However, we have class on Monday and Tuesday is going to be our last class. So probably on Tuesday, I'm going to do some practice exam, right? Some mock exam. Um, so I recommend that you be there. So I don't know how, so the exam so I told you, right? The your grade for this course has two parts, two components. 50% is a group assignment, and 50% is a final exam. And in a final exam, the way it is designed is typically you have some sort of multiple choice question, right? And also what we call short answer questions. And I'm talking about the exam, the other 50%, right? You know what a multiple choice question is. Short answer question, you probably know what that is as well. It's just asking a short question on one particular topic of the that we've studied. For instance, I don't know, what are the main tools of monetary policy, or how does the central bank conduct sterilization operations and in what circumstances? What are the costs of inflation? And you need to explain a little bit what are those costs. So this is what I mean by short answer questions, okay? But on Tuesday, we are going to make the mock exam, practice exam. And but only MCQ, right? Uh, on Tuesday because it wouldn't make too much sense for me to ask you to ask short answer question, right, during an online session. So typically, there will be something like 10 questions to answer. So I will make breakout rooms as well, and you will be able to discuss the answer among the group. So that's the way we're gonna work, right? So on Tuesday, probably a short mock exam in addition to class. We're not gonna do only the exam. We're gonna do also we're not we're gonna do this practice exam. It's gonna be perhaps half an hour, maybe 45 minutes, including the my explanation and the answers. The rest of the day is gonna be regular class. Okay. And finally, I would like to remind you that for the group assignment, you need to organize yourselves in a way that perhaps in a week after the class, You tell your um, contact person as the CFVG, so that would be Cham in Ho Chi Minh City and Lin in Hanoi, about the groups, right? You need to decide and make those groups. Okay, so 3 person per groups, not more, and if you no less than 2. Okay, but 3 at most. No, typically 3, and for the people who could not find 3, but that's going to be 2. Okay, and then you communicate this list of you communicate your group with the name of the people inside this group. Then Cham and Lin are going to send me those uh, groups, and I can allocate the topics of the assignment. Okay. All right, so that's all I wanted to say as an introduction. As usual, let me start by making a summary of what we did yesterday. Okay, um, so summary of yesterday's. Okay, so what did we do yesterday? We started by looking at the other 2 functions of central bank. And we realize there are 2 of them. The first one is actually what we call sterilization operations, right? Which are about offsetting the effect of selling the domestic currency in exchange for foreign currencies as a way to prevent the domestic currency from appreciating too much. Polarization operation, which are about um, offsetting the effect of selling the domestic currency in exchange for the foreign currency by buying back some or all of that domestic currency via almost yes, that is selling bonds against money on the money market. Right? It is what a sterilization operation. China, but Switzerland. Oops, a lot. Why? Um, because otherwise the currency would appreciate too much, harming exporters. Okay, so they're buying a lot of foreign currencies, and to cancel the effect on the money supply, they're issuing, um, they're selling bonds in order to remove some of that base money. Okay, so the case of Switzerland, I didn't talk about Switzerland yesterday. Maybe I can briefly talk about it now. For China, we understand what's going on, right? China is net exporter, right? It sells a lot more goods to the rest of the world than the rest of the world buys from China. In Switzerland, it's different. The reason why people are buying the Swiss currency is because they consider it as a safe asset, right? It's a safe currency. When there is financial trouble, People rush to buy what they consider safe assets, and the Swiss currency is considered to be one of them, right? So right after the 2008 crisis, for instance, a lot of people tried to move their money to Switzerland, and to move your money to Switzerland, you need to buy the Swiss franc. That's the Swiss currency is called the Swiss franc, right? And so it appreciated a lot, right? It was doing a lot of harm to the Swiss economy. So the Swiss Central Bank, which is called the SNB, the Swiss National Bank, had to do something, and they did the same sort of operation that using the Chinese central bank, that is buying foreign currency in exchange for the Swiss franc. Okay, so they have accumulated a lot of foreign currencies, but because they had to print a lot of Swiss franc to do that, they also had to conduct sterilization operations to remove some of that new money that was created. Okay. All right. Second other mission of the central bank is what we call lender of last resort. What is that? Um, well, it is about lending to a bank and no one else wants to lend to that bank. Okay. So you remember on the interbank market, you have suppliers, demanders, you have banks with excess base money, and you have banks with a need for base money. So there's always some activity going on, and it's usually always possible for a bank to raise money on this market. But sometimes when a bank goes into trouble, or for whatever reason, the word spreads quickly, and the other bank starts to hear rumors that this bank is in trouble. So they're reluctant lending to that bank. But if that bank doesn't receive the money that it's owned, that makes it difficult for it to pay the other bank. So there's a risk of a domino effect, right? In which the failure of one bank would impact all of the banks. So to prevent this from happening, the central bank can step in and lend money to that bank in trouble, right? And that's exactly what happened at the very beginning of the 2008 financial crisis, right? I show you the statistics from the Fed when you had this big spike in emergency lending, the red curve. I don't know whether you remember that. The big spike in emergency lending. That was exactly this, right? The central bank acting as a lender of last resort. So it's not OMO, huh? It's directly loans, right? Loans to the banks in trouble, right? So then we talked a little bit about seigniorage. I told you seigniorage is the income coming from privilege issuing currency. So we talked about the central banks seigniorage revenue. One of you made a very good comment that that pretty much says the central bank is making money. Making money. It's very true. But I was thinking about it, and actually, it's true for commercial banks as well. If you think about it, right? They do. It, it, commercial banks, they also earn some seigniorage revenue in a sense. I should probably not use seigniorage, because seigniorage means, I told you yesterday, it refers to some sort of privilege that the king used to have in printing, in manufacturing the gold and silver coins. So we've used that same term to describe incomes generated by the central bank. I'm still going to use that word for commercial bank, but I want to make a comparison here between the central bank and the commercial bank. If you think about it, the commercial bank, when it gives a loan to you, when it lends you money and charges an interest rate to you. But that's the same, right? It's going to be earning money by making money. It's making money when it lends you money. Right? We know that its balance sheet will expand, the liability side will increase by the amount that's been deposited on your account, and the asset side will increase by the amount of the loan. So that's, the commercial bank definitely is creating money. But on top of that, it is going to be earning an interest on that money that it has created. So it's the same as the central bank, right? The commercial bank earning money, making money. That's really a good job. That's really a good job. Broking, of course, there are some regulation that setting the stage and the legal environment within which you can do that. Although we know that for central bank, they have much more room for doing what they want. Okay. And I told you, for instance, in 2014, that signal rate revenue for the Fed was nearly 100 billions US dollar, which is about 2/5 of the Vietnamese GDP. Right? That's quite a lot. All right, then we moved to section 3, and we started talking about the great financial crisis. Started in 2008. I'm gonna put like this because it's not over. It's not. It's not. The right. Um. Uh, what were the causes? I told you, very low, too low interest rate environment in US. There's a excessive credit and therefore money creation. Going in particular into the housing market. So booming housing market. On top of that, you had a relaxation of credit lending, lending requirements. Told you about that. There was some regulation passed in the US in the late 90s, trying to make it easier for poor and disadvantaged households to have access to a home loans. Although it looks good on paper, obviously, in reality, it's well more complicated. Let's put it that way, right? Some of those households, there's a reason why they are poor. They're not earning enough money, so that's going to be difficult for them to put a down payment for the house and to service the mortgage. So this added to the fire. There was also quite a bit of financial innovation, right? And in particular, this MBS, right? Mortgage-backed securities. What is that? Mortgage-backed securities is a sort of it's a financial asset made of the grouping of the securitization of bunch of home loans, right? So think about it this way. Some of you probably have a mortgage, which means you went to the bank, borrowed money from the bank to buy your apartment in Hanoi or in Ho Chi Minh City. So this is an asset for the bank, right? The home loan. because it's earning an interest. You can securitize this home loan by turning it into a negotiable financial asset that can be bought and sold on the financial market, right? So rather than having the mortgage in its balance sheet in the form of a loan, this can be turned into a security, right? Security that's earning an income, and the income is the interest that you're paying on this home loan, right? And once it is a security, then it can be sold on financial markets, right? So banks, they do not have to keep your home loans up until its maturity, right? They can sell it. So that's exactly what a mortgage-backed security is, right? So the only difference being that it's a group of home loans. It's not just one home loan, right? It's a group of home loans. And in the video that I showed you yesterday, which you have here, they were joking about it, right? Because they had this they created this financial product with some funny name like the high grade enhanced, enhanced structural I'm remembering that structure high grade enhanced financial, but it has a very good name. I said yesterday in the sketch, it has a very good name. It does sounds good, right? High is better than low anyway, as I was saying. But in reality, this is just made of mortgages to poor and disadvantaged households, right? So those MBS, they were doing well. Share notes. Those MBS were doing well at the beginning. Why? Because these households, these poor households, HH means households, that's subprime borrowers, right? In the following sense, they are not very good borrowers, they're subprime, right? So because they're subprime, we're charging them a higher interest rate, right? So that means those home loans were paying a good interest to the bank, and therefore, once it's turned into a security, it's a high return investment, high grade, enhanced structure of financial investment. So at the beginning, it looks very good, right? You're lending money to people that are paying high interest rate. The problem is, many of those people turn out to have difficulties paying back, and when it became even more difficult to pay back when the economy and the housing market turned around, right? When house prices started going down, when the economy started going down, and those people losing their jobs, so it was even more difficult for them um, to um, to pay back the loan, right? So that's what an MBS is, right? Mortgage-backed security, some sort of speculative financial investment based, made of the securitization of home loans, and many of those home loans being lent out to people that do not really have the ability to pay back. Okay. And finally, we ended up by looking at this video, which again I encourage you to watch with the subtitles. Okay. All right. I'm going to move back to the public discussion. Before we move forward, do we have any discussion, any question at this stage on this summary? I can see that someone is typing, so guess there's a question coming my way. I'm gonna wait for the question to show up. Two questions apparently. All right, first question. Who and how to sell the government bond to the buyer? So government bonds, I'm going to write this here. Government bonds are sold by the government primary market. So that is when the government issues a bond. It's sold on what we call the primary market. Then these bonds can be negotiated and sold on the secondary market. This is not really important. It's just a piece of vocabulary here. When a financial product is sold for the first time, we call it the primary market and then the secondary market. So who buys those bonds? Well, typically investors, right? Like the banks, for instance, but also in insurance companies. Um, Pension funds. Pension funds is sort of a financial company who collects savings from households and invests, and in particular collects retirement savings from households and invest it into various sorts of financial assets, including government bonds. Okay. So, did I answer your question? Feel free to say no and to perhaps clarify or come back on your question or refine it. Who trading in primary, secondary market? I don't think there would be so. This is quite different. I'm not too sure about this, but it's just a distinction that we make between when assets are sold for the very first time, we call it the primary market, and when they are negotiated later on, it's called the secondary market. But to give you an example, for instance, in the case of France and the treasuries issued by the French government, while you on the primary market, you have a whole bunch of people working at the ministry that are making calls to their regular customers, big banks, big pension funds, insurance companies, asking them whether they want to be part of it, whether they want to buy some of those new bonds that are being issued. So I guess that would be the way the primary market works. As for the secondary market work, but that's the regular money market, the regular financial markets where those bonds are being traded according to supply and demand. Right. I don't think okay, good. Merci. I don't think the buyers are very different whether we're looking at primary or the secondary market. I don't think it's that different. All right, next comment. I did read somewhere another reason of financial crisis was because of the withdrawal of the Glass-Steagall Act. So what is the Glass-Steagall Act first? So it's an act that was passed in the US sometime in the mid 30s that was separating bank activities between the regular retail banking and financial investment and investment banking. Okay, you see, a bank um, can has two sort of activity, right? There's retail banking or commercial banking, which is most would be the core activity of the bank, right? Which is making loans to customers. And the other part of the bank activities is investment banking, so they can make investment on financial markets and so on. So the Glass-Steagall Act was about keeping those two activities separated in order to make sure that any poor decision on the investment side would not spill over to the commercial side, to the retail banking part of. And that's an interesting point of view, obviously. Um, I don't have a definitive answer on that. My guess would be, my hinge would be to say that um, some of the financial institutions that went in trouble in 2008, there were investment banks. I'm not sure they were really commercial banks like Bear Stearns or those type of firms, and those hedge funds as well. A lot of hedge funds went into trouble. You don't, I mean, you it is sufficient for one of these big investment firms to be in trouble for the whole system to be put in jeopardy, right? Because that big bank in trouble will not be able to pay its debt to other bank, right? And that's gonna freeze the whole interbank market, the whole credit market. So you don't really need. I mean, separating the two activities is perhaps a good idea, but my point is, it's not gonna prevent investment bank from making poor economic decisions and going bust and then having to ask the central bank, you see. That's going to spill over to the rest of the financial market anyway. So by separating the two, you're making sure that uh, the investment banking part of Bank A does not impact the commercial banking activities of Bank A. But it will eventually, because if that bank goes bust, it's going to be in need for liquidity, and that's going to spill over to the entire interbank market, and therefore it's going to spill back to itself. So, yeah, it's hard to say. My view on this is that we should just make sure that banks that do poorly, they just disappear, right? Because if there's always this sort of insurance provided by the central bank, then they will always take more risk because they know the central bank will save them eventually. So there's always going to be more money being printed, and it's always going to decrease the value of the existing money. So it's going to harm savers, it's going to harm the regular people that are trying to save for a deposit, for instance, or for a rainy day. So my view is that rather than doing things like the Steagall Act, we should make sure that, as in a regular free market economy, right? If you make poor decisions, then you go bust. I mean, if you're a restaurant and you're selling crappy dishes, and every time someone walks in, have a dish, and then get out and is sick, then the restaurant's going to close because it's offering a poor service, right? Why would it be different for banks? So people would argue, well, bank is different, blah blah blah. But I guess the reason why they're making so many poor decisions is because there are no consequences for them. Because the central bank is going to intervene eventually. We're going to talk about that more when we talk about free banking, because free banking is exactly about this, right? It's about removing the central bank because it creates bad incentives. Okay, I don't want to expand too much on this now because we're gonna talk about it, but I hope I answered your question. Normally, for sterilization, the amount value of foreign currency that the central bank buy will be equal to the security that the central bank sells to. I would say not necessarily. I mean, it's up to the central bank, right? It does what it wants. It can sterilize the exact amount, or it can sterilize less or more. I don't think there is any rule here. I don't think there is any regulation that would force one that would force the central bank to do it, to sterilize exactly the amount of foreign currency that it has bought. Okay, it's well, maybe I guess it really depends on the country as well. There might be some regulation somewhere saying it. Okay. All right. Any other question or comment? Oh, someone is typing. So yes, sir. Another question. Good. Maybe you were just agreeing to my answer, perhaps. All right. Some of you are typing. Thanks. Okay. So it sounds like I can move forward. No, please go ahead. Okay. Good. All right. So let's move on. So this is where we are. So what was the Fed's response to this crisis? Well, we talked about that already quite a bit. So I'm not going to going relatively quickly here. The Fed responded aggressively to the financial crisis by supporting the liquidity of financial institutions. It first provided short-term liquidity to banks. We know that. Remember the graph that I showed you? It was that big spike in the red line. That's through the discount window. And then, as those emergency loans were paid back to the central bank, some open market operations were taking over. And in particular, those open market operations were their purpose, their goal was to purchase MBS, mortgage-backed securities. So that's interesting because typically, before the financial crisis, the Fed could, by law, only buy bonds. And its main tool for conducting open market operation was actually government bonds, treasuries. So they had to amend the regulation and the law to make it possible for the Fed to buy this new type of asset now, mortgage-backed securities. Okay, and that's what we call QE, right? Quantitative easing. They always find some funny names in the US, right, to make it look like quantitative easing. Make it look like it's perfectly normal, but they're really doing something not normal, right? Printing all this money. So the first QE was about buying 40 billion per month of mortgage-backed securities. That's a lot, right? So you had all these dodgy assets. Remember, that's the dodgy. Let's try to find a definition of dodgy. But I think you can figure out what that means. Right? Dodgy means dishonest, unreliable. Dishonest, unreliable, low quality. Potentially dangerous. That's what I was saying yesterday in the video. They were talking about dodgy assets. MBS were dodgy assets, right? So if we look at the balance sheet, because we're very familiar with balance sheet now. You remember yesterday I was talking about the unreasonable bank. It's unreasonable because it has made a lot of poor decisions in terms of home loans, right? So those home loans, they are sitting on its balance sheet. But if assume the bad loans, assume there are two options, right? Uh, either let's step back in time a little bit. Either we have this answer, right? The entire amount of bad loans. We're just making things we're simplifying things obviously here, but the idea is true. Assume all those bad loans disappear. That would turn, and we made a very step-by-step exercise yesterday that I did with multiple colors, you remember? If the poor household do not pay back the loan, that's a loss for the bank, and potentially the bank will go bust if the loss is bigger than its equity. And very likely it's going to be the case, right? Because the loan portfolio was massive. Well, another option is that one. Rather than having a loss showing up, bang, you just have an expansion in base money because all those MBS were bought, were purchased by the central bank. So rather than having the bad loans here, but you have base money instead. And that means that now the MBS have landed into the Fed's balance sheet. So this is the Fed's balance sheet before purchasing the MBS. So it's a regular balance sheet, right? We have some cash, we have some deposit by financial institution. All this is zero, right? We know that. And on the other side, we have the bonds. That's before buying the MBS. Once the Fed decides to buy the MBS, that's how it looks like now. Bang. As you can see, the massive expansion of its balance sheet, right? Because the MBS are now sitting on the asset side of the central bank, right? And as a result, the amount of deposits by commercial banks and financial institutions has increased by the exact same amount of the amount of MBS that was purchased by the central bank. Okay. So you see, let me step back to make sure it's very clear for you. So this is the commercial bank's balance sheet for lending decisions. Rather than letting the bank go bust, as I showed you before, this is what happens. All those bad loans, they are purchased by the central bank. And therefore, the central bank's balance sheet is not going to change. It's still going to stay at 300. But rather than having bad loans, now it has base money, right? Why? Because those bad loans, those MBS, they've landed here, right, in the central bank's balance sheet. Okay, so this is really important, and that explains. And I'm going to try to move back. Do we have the slides? And I'm gonna upload some this guy. I'm moving back to the section 2. I want to show you that graph again. Let me see. So bear with me for a second. I'm just trying to recover that very nice graph. I need to find which slide it is. That's 56. All right. Oops. You see, so we had this emergency lending at first. That's this part. And then it was replaced by QE. And this QE, that's right here, right? From here. And here as well. And that was about buying back MBS. As you can see, it's right there, right? So the Fed was buying those MBS from the commercial banks from the banks and the financial institutions that were in trouble. Okay. All right. So that was a very unconventional monetary policy. Massive amounts of base money sitting in the bank's balance sheet, massive amounts of liabilities for the Fed. I mean, it's unprecedented. That's something you need to understand. It's unprecedented. Unique. Never seen before. So much new money being created. It's amazing. Trouble down the road. Huh? Problem. People. So that was after the the QE. The people and the businesses were not borrowing and spending as much as the very loose monetary policy was trying them to. Now things have improved since the mid 2010s, right? 2015, 2016, but it took a very long time for the US economy to recover and to move back to relatively high GDP growth rate, right? Well, we talked about that already, right? Monetary policy is only an indirect impact, right? Monetary policy and only indirectly influence on creation and credit. Agents do not want to borrow. You cannot force them. Okay, that's why we say that monetary policy is like a string. You can pull the string, but you cannot push the string, right? So you can raise interest rates very, very high, and then eventually it's going to start impacting on people's decision whether to borrow money or not. And I gave you the string example yesterday. So you can pull the string, but pushing a string doesn't do much, right? You can bring interest rate as low as you want to zero. If people do not want to borrow, they're not going to borrow, right? Assume you want to buy a house, 100,000 US dollar. Expect the house price to fall to 50. Hey, you're not going to borrow money, right? Even if it's 0%, because you will be losing your house. The house price will be going down, so you're not going to be borrowing. So it's important to remember that. All right, so that's it for the 2008 crisis, right? So I'm happy to take questions. I guess now that we've worked with those balance sheet, it makes it relatively easy to understand what happened, right? Do you have any question? Okay, it looks there's no question. Perhaps just one final comment. So if you look at the Fed balance sheet before the COVID crisis, they were little by little selling back some of those assets that it bought after the 2008 financial crisis. Right, its balance sheet, which expanded massively, was starting to decrease a little bit, but because of the COVID crisis, I'm not sure. This is true anymore. I'm gonna quickly have a look on the web to see how the Fed balance sheet has been doing recently. It's not clear. Oh, that's the Fed website, so I should be able to find information. Recent balance sheet trends. Oh yeah, very bad. I'm gonna show this to you. It's even worse. My goodness, crazy. Okay. Um, Fed balance sheet. I'm going to show this to you. Um, so that's total assets. Yeah, that's how about liabilities? I'm going to share my screen now to make sure you can see what I'm doing. So this is the Fed asset side. So you had this big jump in 2008, right? If you look at the time, and so that was the emergency lending. Then little by little, the open market operations took over QE1, QE2, QE3. So as you can see, things were pretty much flat, and as I told you, were starting to decrease. And then the COVID crisis hit, bang, bang, bang. So now we are it's it's a lot. So we're going to look at the liabilities as well. Um, so this is the treasuries. So the Fed bought the treasuries. In blue, you have currency in circulation and the deposit by financial institution. Okay, impressive. All right, let me close that down. I'm going to exit the screen sharing. All right, any question? I see that someone is typing. I'm going to wait for the answer, the question. Regarding 2008 crisis in the US, both Lehman Brothers and insurance company AJ went bankrupt, but government well. I don't really know actually the answer. I mean, this is at this level, this is probably political. Right? I'm not even sure it's. They had to. I should read about that again. I had some sort of answer at some point, but they they. I would give you a very simple answer. It's probably not correct, so I'm gonna try to look at that. But they have to let one bank go down, right? At least for to give an example, right? Because if they were saving everybody, that would look really bad. That people would start to understand perhaps that this is all fake, right? The Fed can print as much money as it wants. So why do we have this? Why do we have to pay back loans, by the way, right? Because the Fed can print money as much as it wants. Why do we have to work? I mean, we can go as far as saying, what do we have to work? Because the Fed can print money, right? If it can save everybody's, every bank, why not save individuals, right? So that's a bit of perhaps an excessive answer. Probably Lehman Brothers was the situation was too bad. Uh, they made really poor, very very poor decision. They lost too much money, so it was impossible to save them. By contrast to some other banks, I would say. But yeah, it's sort of a half-baked solution. Either you let everybody fail, or you let nobody fail. Right? And here they picked winners and losers. That's I'm not sure why. Because Lehman is investment bank and IJ is insurance company. Yeah, maybe that's why. I remember that Lehman Brothers refused an offer from another bank in the hope that the Fed would back down. That's probably true as well. I need to read more about the exact story and how it unfolded regarding Lehman and all these other big financial firms. Um, Impact of Lehman was assessed by Treasury and Fed, and they thought that Lehman bankrupt should not have any impact on private sector. That's one another option. Yeah, it looks like you know more than I do on this. Yeah. Well, that is typing, so I'm waiting for. However, AG case is always holding insurance, and that's right. That's right. Yes. 401ks are the savings account for US households, so you don't want to let that go, right? That would look very, very bad. But you can look into one of the articles that I recommended to you to read. I'm sure you're going to have answers to at least some partial answers to those questions. Some more comments, so I'm going to wait for those comments. Well, perhaps there's no more comments. Okay, so well, thanks for your participation, for your comments. It's very interesting. Yeah, I know it's puzzling in a sense. Some financial institutions were bailed out and some were not. You provided some possible answers. I'll try to look it up myself. All right, now that we're done with the 2008 financial crisis, I suggest we move to another monetary crisis. It's more monetary than financial this time, so it's also very interesting for our purpose here. But it's very different in nature, right? It's important for you as a Vietnamese professional to understand what's going on in Europe, because there will be consequences down the road. Yeah? Just like for the 2008 financial crisis, what's going on in Europe with the euro crisis um, will spill over eventually and already spills over to the rest of the financial world. Right? You have to realize that the US economy and the European economies are pretty much the same size. So they are really, really big economic entities. So whatever happens in those regions has an impact in other parts of the world and especially in Asia. Okay. So you're going to see that I'm not very optimistic about the fate of the euro. Many economists, including myself, consider that it's a ill-designed currency. In the sense that we've put together in a common currency countries that do not have much in common except for being located in the same part of the world, right? And technically speaking, they do not meet the criteria for what we call an optimal currency area, right? OCA, an optimal currency area. We're going to talk about that. Is some sort of criteria that need to be met before implementing a common currency. Okay? For instance, in Vietnam, it makes a lot of sense to have the same currency in the north and in the south, in the west and in the east, right? But probably would not make sense for Japan and I don't know, perhaps Myanmar to have the same currency, right? Japan is a very rich country with rich countries' problem. Myanmar and Cambodia, for instance, are relatively poor countries with poor countries' problems. They need a cheap currency, for instance, right? Whereas the Japanese yen is a strong currency. So putting all these countries, Japan and Myanmar and Cambodia together into one currency union with one single currency doesn't sound very good, right? Doesn't sound like a good idea because they do not have the same needs in terms of monetary policy. Probably low interest rates in Japan and high interest rates in Cambodia, for instance, to prevent too much inflation, whereas it's deflation the problem in Japan. You see? So, well, what is true for Japan and Cambodia is probably true for Germany and Greece, right? They are very different countries. They don't even speak the same language and they have the same currency. So, not really good. So, we're going to talk about that. Not too long because it's quite technical. So, we're going to start with a bunch of facts. First of all, we're going to start by saying that since the end of World War II and since the creation of the euro in 2001. The euro was created in 2001. Labor costs have increased faster in Southern Europe than in Northern Europe. Let me show you some statistics. So, I didn't realize there was another comment. One more thing, AJ was have real asset backed. Lehman Brothers did not end. All collateral of Lehman Brothers was just crap. Okay, that's probably true as well. Okay, let's go back to this euro. So here is what I wanted to say regarding the labor cost. So assume we all normalize. So that word to normalize, that verb. Okay. Assume we normalize all labor costs to 1 in March 2000 in Europe. Okay, of course they were different. We'll assume we bring them back to the same level, and then we look at their growth over the next 11 years, right, up to 2011. Right? What do we see? We see that for a country like Spain, for instance, labor costs increased by nearly 60%. By contrast, in real terms, by contrast, in Germany, they increased by 25%. So you see, we have a 30% excess increase in labor costs in Spain. Right? Labor costs increased way faster in Spain than it did in Germany. But that's true also for France. Look at labor costs in France. They increased by 45%. That's Italy, 38%, right? So why is that a problem? Well, if all those countries had their own currency, well, typically the currency would depreciate with their own currency. Each country's currency would depreciate according to the excess depreciation in labor costs. Why is that true? I mean, assume you're a German company and a Spanish company, you're selling the exact same product, same quality, same price, and we are right there. We're right at the beginning of the period. And then you look 11 years later, Spanish labor costs have more than doubled compared to they've increased twice as fast as the German ones. So the only way to keep your profit as a Spanish company is to increase the price of the good that you're selling and increase it more than the German company did. Otherwise, you're going to be losing money. But as a Spanish company, if you do that, if you increase your selling price by more than the German company for the same level of quality, people are going to buy the German good, right? So the only way you can recover some sort of competitiveness is by letting your currency, the Spanish currency, depreciate, right? Because if it depreciates, then it's going to bring back, once the good is converted into the German currency, for instance, it's going to bring it back to the same level, right? So that's what I've just described here was at the core, was at the heart of the European economies from the 50 years after World War II up until the creation of the euro, right? If you have a country whose production costs are rising too fast, the currency has to depreciate to compensate, right, to restore some sort of competitiveness. And that's exactly what was happening. Look at the next slide. This slide, for instance. This is, again, a normalization. I'm going to come back to the slide that I've just skipped in a moment. But this is a German mark exchange rate versus other European currency. Okay, assume again we normalize everything at 1 in 1980. With 1 German mark in 1980, you could buy 1 Greek currency, 1 unit of the Greek currency. But in 1995, you could buy 7 of them. So that means the Greek currency depreciated very fast. The Portuguese currency depreciated quite a bit as well. As you can see, it went up. Same for Italy and Spain. Not as spectacular as Greece, but quite a bit. So this is exactly what I was saying, right? Those countries, they had production costs increasing faster for various different reasons. So to restore some sort of competitiveness, the currency had to depreciate, and that was working, right? The Italian currency, the Spanish currency were losing ground against the euro, but that was fine. That was bringing back some sort of equilibrium. So this is a summary of what I've just said. Before the euro, southern European countries used to devalue their currency or let it depreciate to compensate for faster rising labor costs. Since the euro, they cannot do that anymore since the exchange rate has become, since the exchange rate between all former European countries is fixed. Yes, you see, they've introduced the euro right there. I'm going to draw a straight line, and I'm going to pick blue as well. Greece joined a little bit later, so that's why you have a bit of movement here. It joined a little bit later, but all other countries joined in late 90s, early 2000s. So as you can see, from that point onwards, it was impossible for those countries in Southern Europe to devalue their currency, to let their currency depreciate against the German mark or against the French franc, for instance. So that means they had, but their labor costs were still increasing, right? So they had increasing labor costs, but they could not compensate those increasing labor costs by depreciating their currency. So as a result, they were losing market share, right? Because the German products were not increasing in prices, whereas the Spanish one, the Greek one, the Italian one were increasing in prices because they could not devalue their currency. Okay, so think about Vietnam, for instance. In Vietnam, the Vietnamese dong always fluctuates; it goes up and down. And when economic times are difficult, typically the Vietnamese dong goes down, and that makes life easier for Vietnamese exporter because the Vietnamese currency has depreciated, so they can sell their goods. It's easier for them to sell goods abroad because the Vietnamese currency has depreciated. Well, think about the European situation as a situation where this is not possible. Greek, Greece, Spain, Italy, France, they're all stuck with a fixed exchange rate towards the German, and that makes life really difficult for them because it's not the way it's been working. Right? They used to devalue, they used to let their currency depreciate to restore some sort of competitiveness. Okay. I can see that someone was typing, so maybe there's a question coming up. So you see, this is what I was just saying. This means that faster rising labor costs simply means more expensive and therefore less competitive products for Southern Europe. Okay, why? Because their currency cannot depreciate anymore because they have joined the euro. Why Southern European countries' labor cost more expensive than Northern? That's good. There are various different reasons. One of them would be inflation, right? Higher inflation. That here. Oops. Higher inflation. um, stronger unions, perhaps. Um, but that's just cost, actually. Another big reason is that productivity was rising faster in Germany and in Northern European countries than in Southern Europe. Okay? If productivity rises faster in Northern Europe, that also means that your labor costs are falling in a sense relative to Southern Europe. Do you see that? So there are two sides of this labor cost thing. There's the real cost, like higher inflation, stronger unions, and so on. And there's also the productivity side of it, which is important. If productivity rises faster in Northern Europe, which it was, but that means they can produce more goods with the same amount of time, or they can produce the same amount of goods with less time and therefore less work and therefore at a cheaper rate, right? So it's not only the nominal cost, it's also the productivity, right? Is that clear? Okay, thank you. Um, let's move on with our story. So, so that's really, really, really important to understand what's going on in Europe right now. Okay, the governments and central banks, they're trying uh, to hide the problem by printing money, by borrowing money. But the real problem is that Southern Europe has become uncompetitive because of the fixed exchange rate. Okay, that's really difficult for them, right? Their only option would be to decrease their labor cost. But decreasing labor cost means decreasing people's wages, and good luck with that, right? You're not going to tell the Greek people and the Spanish people and the Italian workers, well, if you want to stay in the euro, you have to decrease. We have to decrease your wages. They don't really care about that, right? They want to have rising income rather than being forced to stay in the euro. So that's really the main problem. And I'm going to describe another problem, which is perhaps a little bit less significant, but still with some repercussions. Here it goes. So before the euro, domestic interest rates used to reflect national risk premiums. What does that mean? Well, it means typically the average interest rate in the country takes into account, obviously, the average rate of return on investment and capital in this country, but also the risk associated with investing in this country. Okay? So that's why. So do you mean Northern European countries are taking advantages? Are taking advantages, you mean? It's a good comment. I'm not saying they're doing it consciously. I am not saying they're doing it on purpose. I'm saying this is an outcome of the euro. Okay, this is the result of the euro. Because southern European countries cannot devalue anymore because they cannot let their currency depreciate, that they're losing ground, they're losing market share, they're losing competitiveness. So of course it benefits to Northern European. So that's very true. Uh, I don't think this was made on purpose, right? It's the politicians who designed the euro didn't perhaps think enough about the consequences. By the way, the decision to set up the euro was made up by politicians. There was not many economists involved. A lot of economists were very skeptical, including some very famous ones like Stiglitz or Krugman or Milton Friedman. Well, they were very skeptical. They realized it's not an optimal currency area. Right? So why does UK try to avoid joining the eurozone in the first place? But for that very same reason, they understood that monetary policy, having your own exchange rate, having your own interest rate, is important to buffer the shocks, right? Like in Vietnam. In Vietnam, you're happy to have your own currency, so it goes up and down depending on the business cycle. And when the economy is not doing too well, the Vietnamese don't depreciate, and that gives a bit of breathing space to exporters, right? That means imports are more expensive, but that's fine. I mean, if imports are more expensive, that means you're going to buy less from abroad and more from your own domestic economy, which is good for your own economy. So you see, a cheap currency benefits the domestic economy, and Southern European countries cannot benefit from that. So the UK, they sort of understood that tying yourself, constraining yourself within the framework of the euro was probably a bad idea because they would lose their independence in terms of monetary policy, in terms of interest rate policy, in terms of exchange rate, right? So I think they were clever not to join the euro. Another, they've even exited the European Union, right? You have the euro. I'm going to write that here. Euro, oops, nope. The euro is the common currency. The European Union is different. It's a free trade agreement plus some other common policy, but it's different from a common currency, right? So the UK, the United Kingdom, so far they were part of the European Union, but they were not part of the euro. And now they've also exited. That's the Brexit, right? They've also exited the European Union. So the ECB lawmakers are not as clever than indeed. Well, I agree with that. I mean, it's not really the ECB lawmakers, the people that set up the euro in the first place. But as with everything, there's always, it's not black and white. It's not 0 and 1. There's a lot of shades of gray, right? Um, just like in France, right? It makes sense to have the same currency in France, within France, although some parts of France are doing much better than some others. Does that mean we need a single currency for the entire world? Yeah. But if you ask yourself this question, should we have one single currency for the entire world? Intuitively, we realize that there would be something wrong. Why would Switzerland need the same currency as some poor country in Africa? Right? Probably they need different interest rates. Probably they need different exchange rate. Probably they need different monetary policy because they are at very different stages in terms of development, right? So why would you impose a common currency to Switzerland, Japan, Congo Brazzaville, Argentina, whatever, right? That wouldn't make sense. So if that doesn't make sense at the world level, but it makes sense at the very local level. For instance, it makes sense to have the same currency inside Ho Chi Minh City. You don't want to have a different currency in the District 1 and in District 10. That would not make too much sense. So there has to be some sort of middle ground, right, where the costs of having a common currency are greater than the benefits, right? And in the case of the euro, it's very clear. Okay. But those were good comments, so thank you. So I want to go look at another problem which is related and that also makes things difficult for many countries in Southern Europe is the fact that before joining the euro, each country had its own interest rate, in its own average interest rate, for instance, the 10-year bond, right? 10-year treasury bond, 10-year treasury. Okay, what's the rate on the 10-year treasury in Vietnam? Let me check that out. 10-year bond Vietnam. That's 2.44%. Is that correct? No, that's not. What are those? Yes, nearly 2.4%. Trading economics, that's usually good. Good. Oh yeah, that's fallen quite a bit. My goodness. Hmm. So the 10-year bond in Vietnam is around 2.4%, the interest rate. Okay, that's the rate that the interest rate that the government must pay to borrow on a 10-year maturity. Well, look at what happened for those 10-year bond yields in Europe. Again, very interesting. So here you have the introduction of the euro. Okay, and 90s. As you can see, each country had its own 10-year yield, 10-year interest rate, right? Countries that were considered risky, such as Greece, for instance, right there, had a much higher interest rate than countries that were considered safe, like Germany here. Okay, and same for Italy, for instance. This is the Italian in blue. Okay, so before joining the euro, as you can see, each country in Europe had its own interest rate that was reflecting the average level of risk and return on capital in that country. As the euro was created, all interest rates converged. That's a pretty nice graph, very impressive here. As you can see, for about 10 years, all countries in Europe had the same interest rate. It's amazing. So for 10 years, financial markets, let's put it this way, between 2000 and 2009, financial markets consider that Germany and Greece have the same level of risk. The same risk. And after the financial crisis, as you can see, bang, it's very nice. Very, from a graphical point of view, it's very spectacular. All interest rates kind of started going back to their pre-euro level, right? Pretty impressive. So why is it important for our story? It's important because during all those years, a lot of countries in Southern Europe started taking advantage to use theory that the young lady was using. Southern European countries took advantage of this new, unique, very low interest rate environment. So we had a lot of borrowing from governments and private agents. Let me show you that. Um, Many households and government in Southern Europe took advantage of those historically low interest rates to borrow money massively. Many government and households are now heavily indebted, but interest rates are pushing back up. Many governments and households will not be able to pay back their debt if interest rates go back to pre-euro levels. Okay. So the important thing to realize is that if you're a Greek household, right, in 1940, 1984, 85, to buy a house on a 10-year mortgage, you had to pay 25%. 6 years later, you had to pay 5%. It's a drop from 25% to 5%. It's massive. I mean, it's really huge. So this had a lot of impact on borrowing demands, right? A lot of people were taking advantage of this. So this contributed massively to an increase in the amount of debt in Southern Europe from private agents. For instance, in Spain, they invested in the housing market because of this new low interest rate environment. And in many countries, it's the government that borrow. So it should offset the first impact, I think. Yes and no. Why? Um, Let me write that on the next slide. This is borrowed growth in a sense. Okay, these countries were growing because they were borrowing. Therefore, spending incomes to be earned in the future. Right? So they are sort of bringing growth from the future back to the present, right? Because of this low interest rate environment. Uh, I think it was on the first or second class. I told you that real GDP growth is all about labor productivity. You're going to become a rich country if labor is productive, not because you're creating too much money. Do you remember that? Creating too much money means having low interest rate, having a lot of credit. You're just borrowing growth from the future and bring it into the present. Right? That's why I told you. Someone asked me, "What is the main indicator that the financial crisis is around the corner?" I told you it's when there's too much borrowing, because borrowing means, well, you're borrowing income from the future, so you're borrowing growth from the future. But you're not growing because of improving productivity, because of increasing the stock of capital, of human capital, of better technology. You're just growing because you're borrowing money, right? So it's not healthy. It is not healthy. Growth. Saying low interest rate means low inflation means lower labor cost. Um, it also it all depends on productivity. You see. If inflation is low, but productivity increases, and labor cost increases in returns. Okay? So you see, that's really the way you should look at it. The interest rate is a price, and each country has an interest rate that roughly reflects its average level of productivity, of risk. And if you bring this interest rate artificially low, just like Euro did here, why that means the interest rate is not aligned with your level of productivity and risk anymore. And obviously, people are going to take advantage of it. And as you can see, soon enough, financial markets started questioning that convergence, right? This is what you have here. Right? Interest rate went back to their pre-euro level. I see. So the core reason is that Eurozone is trying to merge less productivity. That's exactly that. when you have, I mean, you can have a common currency for uh, regions or countries that are relatively similar in terms of productivity. When you put together Germany and Greece, whereas in Germany you have very rapid productivity gains and low inflation, whereas in Greece you have very small productivity gains but high inflation, and that means in Greece they need to have a cheap currency. That's the only way out. Just like poor countries tend to have cheap currencies, and in rich countries like Japan, like Germany, like Switzerland, they have an expensive currency because they have high productivity and low inflation. So when you put these two together, that's a recipe for disaster. That's what I'm saying. The Eurozone model should be successful for countries on the same exactly, but they're not. So it's wishful thinking. Right? We wish they were the same, but they're not. So either we cry about it, or we realize it's not going to happen, and we stop the we try to reverse back to something that's more healthy, right? Let's move on because I don't want to spend too much time on euro crisis. I know it's very interesting, but I want to move to the Bitcoin and the free banking stuff. So how many slides left do we have? Okay. So long-term solution. The best way for those highly indebted Southern European countries is to pay back, to grow. Because if they grow, they can pay back the debt. But the problem is that the euro is too strong, that it's too expensive for many of these countries using it, making it difficult to export their way out of the crisis. And temporary solution has been the ECB is providing liquidity for free to European banks so they can buy government bonds from heavily indebted Southern European countries, driving down interest rate. That's the fix I was talking about earlier on. Mhm. The temporary fix. The ECB gives money to European banks so that they can buy bonds from Southern European countries. By doing that, well, we know, remember what I said about the relationship between the price of the bond and the rate of return on the bond. The more you buy bonds, the higher the price of the bond, the lower the rate of return. So that's what they're doing at the moment in Europe, providing huge amount of liquidity. The ECB is printing money exactly the same way as the Fed has done with the MBS, right? You remember? The MBS, the Fed created those emergency lendings and then the open market operation, QE1, QE2, QE3. While in Europe, we have something similar, but rather than using that money to buy MBS, it's to buy government bonds. For instance, I think it's about 20% of, I'm going to put that in a different color. About 20% of the Greek, Italian, Spanish, etc. government are held by the ECB. So about 20% of those debts, sovereign debt, are held by the ECB. There's a very large chunk that is held by the commercial banks as well because the ECB is providing them liquidity. So as you can see, it's not very healthy, right? This debt, if it was good debt like the Swiss one or perhaps the Vietnamese one as well, I'm not sure. This would be held by private investors because they enjoy it, not because they are being forced to do it, right? So in July, so if you look at the crisis, how it unfolded. So let's step back a little bit in time. So that the euro that is being introduced, we have 10 years relatively quiet, and then interest rate go back up, and then that starts to be a problem. So in 2012, the chairman of the ECB, who was Mario Draghi by then, now it's Christine Lagarde, he said, within our money, the ECB is ready to do whatever it takes to preserve the euro. So you see, we had this big spike in interest rate, which corresponds to that period. Right? And then the ECB provided this massive amount of liquidity. Massive liquidity injection. Banks, so that they can buy government bonds. As a result, interest rates went back down. Okay, but it's artificial. You see, it's artificial because this is due to those massive liquidity injection by the ECB. Okay. This is a debt to GDP ratio in Europe. As you can see, it went up quite a bit after the financial crisis, precisely because a lot of government had to borrow to bail out banks, for instance, to support the economy. Problem number 3, we've seen problem number 1, those Southern European countries, they cannot devalue anymore. Problem number 2, there was a very long, 10-year period of very low interest rate, and governments and private households took advantage of it, and that translated into a massive increase in debt to GDP ratio. Problem number 3, a monetary union requires fiscal transfers from richer regions to poorer ones. And there is very little of this in the euro area by contrast to the USA. If you look at the US, for instance, there are a lot of transfers, fiscal transfers from the rich states, such as Connecticut, Massachusetts, perhaps New York State, Maryland, those rich states, towards the poorer states like Mississippi, Louisiana, I don't know, some of the southern states that are not very rich. So we have a lot of fiscal transfer, right? That compensate for the difference in productivity and competitiveness. But in Europe, there's very little of that. There is a little bit of it. And for instance, when you go on holiday to Greece, you can see that some of the motorways have been funded by the EU. That's just very small. So it is not enough to bring back some sort of balance. And in particular, it's not going to save the low productivity problem of Greece and Italy compared to Spain, to Germany and the Netherlands. Problem number 4, one size fits all monetary policy cannot account for differences in business cycles across country. That's true as well. Yeah, I told you. Let's going to talk a little bit about what we call an optimal currency area. Optimal currency area. Look at the exact criteria. One of them. Optimal currency area. Well, I'm going to give you my version. So you need to have labor mobility. You need to have capital mobility. Okay? You need to have labor mobility. You have to have fiscal transfers. and relatively synchronized business cycle. If you have those four, and that could make sense to have a common currency. Why? Because when there's a region that's doing bad, for instance, in the US, I don't know, assume Mississippi is doing bad, and the money can flow to a country doing well, like North Dakota. The people can go work in North Dakota. There's some fiscal transfer between rich and poor countries, and there are the relatively same business cycles. In Europe, you don't have that, right? You have capital mobility, that's for sure. You don't have labor mobility, not that much. For the average Greek person doesn't speak German, right? As I told you, you don't have that much of a fiscal transfer. And the business cycle is not very much synchronized, right? Germany is doing well because the euro, for Germany, the euro is too cheap. And Greece is doing bad because for Greece, the euro is too expensive. So, as you can see, not very good. All right, so here we are to summarize before we make a break. So Southern Europe has become very uncompetitive. It has lost control over the exchange rate, has lost control over monetary policy, and has no room for fiscal stimulus because of the high debt. And it does not receive the sort of fiscal transfer that a proper monetary union like in the US requires. As you can see, this has fallen since then, but the impact on unemployment was pretty bad, right? The financial crisis and the euro crisis. The greater any of the four linkages between the countries is below, the more suitable common currency. Rather, I've just described them. So capital mobility, that's business cycle synchronization, labor mobility, and fiscal transfers. So that's the optimal currency area according to Robert Mendel, who won the Nobel Prize a few years ago. Let me give you one last. There's another slide after, but that's the next to the last one. A quote by Milton Friedman, who's, in my view, one of the best economists of the 20th century. He said the following: "The Europe exemplifies a situation unfavorable to a common currency. It is composed of separate nations speaking different languages with different customs, and having citizens feeling far greater loyalty and attachment to their own countries than to a common market or to the idea of Europe." Right. So, oh, by the way, I have another funny saying. I don't know who said that, but I think it's good. It's another definition of the euro. The euro is a bad solution to a non-existing problem. Ah, I found that funny. Why is that? There was no problem. I remember what I was saying. Each country was the country of each currency. Sorry, the currency of each country was depreciating according to its loss of competitiveness with regards to Germany or Northern Europe, and that was fine. Right? The countries were doing well. Okay, so there was no problem. So they introduced something that doesn't work to solve something that was working. That's yeah. I think I'm gonna leave it here. Perhaps one last slide. So what's the end game? What's the solution to all this? As you can see, I'm not very optimistic. I think this was not a good idea. So the first option is to bring back competitiveness to Southern Europe. We need many years of price and wage deflation in the south to restore competitiveness, but that's very painful. I mean, we're talking about asking agents for to reduce their wages, right? And I don't think it is going to happen. So the other option is a breakup of the euro, right? So each country goes back to its own currency and takes back control of monetary policy, interest rates, exchange rate, just like Vietnam does. Right? In Vietnam, you have your own monetary policy. I'm not saying it's perfect. I'm not saying they're doing it perfectly, but at least you have it. You can use it. You can you can see your currency goes up and down depending on the business cycle. Greece, Italy, Spain, they cannot. Right. All right. I suggest we make a break now, and I'm gonna take question on this after the break. Okay. So I think we're gonna make a 15-minute break. Okay. A bit longer than usual because today is a bit unusual. Okay. So it's 9:45. So I see you guys at 10. All right. Let's go. Okay, welcome back everyone. All right, before we move to the next set of slides, which will be section 4, I'm happy to take a question on what we just did on this Euro story. So again, the reason why I spend a few minutes talking about it is as professionals working in the banking and financial industry, it is important for you to understand that the euro crisis is not over, that it will keep unfolding in one way or the other, perhaps more economic integration, perhaps less, perhaps a breakout. So you need to understand what is going on in Europe because it has a huge impact on the world economy and the world financial market. You need to understand what's going on there in order to make good economic decisions and to be prepared, to be able to anticipate if you see that suddenly things accelerate again and the crisis comes back at the forefront. So that's why I thought I should let you know a little bit about this. So I'm happy to take question. I can see that one of you is typing, so I'm going to wait for the question. And as I said, the US economy is about 20% of the world GDP and same as Europe. So if you take these two together, you're nearly at half the world GDP. So interest rate reflect national risk premium. So does lower interest rate reflect higher or lower risk? It's a combination actually. So the interest rate uh, at um, average interest rate in one country is a combination of the expected rate of return and to the risk premium. So you see, if in countries that are growing fast, the interest rate will be high because they're growing fast. One reason being the rate of return on investment is high, but there's also the risk premium component. For instance, let me give you an example. In 1990, for instance, right after the fall of the Soviet Union, interest rates in Russia were around 60% per year. Uh, that 60% had nothing to do with the expected average rate of return on capital in Russia, which was pretty much negative. Right? It was mostly related to the risk premium because the country was so disorganized. There was so many problems over there. It was very risky lending to the Russian government. Right? So that's what I mean by risk premium. By contrast, lending in Germany and Switzerland today, interest rates, most interest rates, many rates are negative, right? Which means, oops. Okay, which means that there's so little risk. There's so little risk lending to the German or Russian, German or Swiss government nowadays that people are happy to lose money in order to lend to this government. That tells you something. That tells you something. So do you to come back on your question, do you think euro crisis is going to lead to the next world financial? Uh, um, I'm not sure. Let me just say that I don't think this is over. I don't think this crisis is over. Uh, euro crisis is over. Why? Because the key problems haven't been addressed, and that's differences in productivity growth mostly, right? And therefore labor costs. This hasn't been addressed. So if you keep the same currency between those countries, it's going to be very difficult. So there are, as I said in this slide, there are two options. Either we turn into a real currency union, so there will be huge fiscal transfer from Germany, Netherlands, perhaps France as well, towards the countries in the south. That's not going to happen politically. I mean, France is not in especially good shape at the moment, and I don't see where the money is coming from. So yeah, it's gonna come back at the forefront. Will it be the next financial crisis? I'm not sure. You should keep an eye on the disaster that has been the lockdowns in Europe and in the US on the economic activity. By the way, do you have a lockdown at the moment in Vietnam? Are you under lockdown? Lucky you. Here, they're locking us down for no reason. So, yeah, I wish. I wish. I told Tram and Lynn, I want to come. And they told me, well, Richard, I know you like to come, but not this year, sorry. And that's too bad. That's too bad. Uh, but no, I don't want to talk about this because the situation is not being handled very well here. So anyway, so and the other question, interest rate reflect. So interest rate reflect national risk premium. So does lower interest rate reflect higher or lower risk? As I said, it's a combination, right? So your interest rate can move up and down for various different reasons. It can be artificially brought down by the central bank, as we did, but that's not usually sustainable. In the long run, the long run interest rate we should move back to some sort of core fundamentals like average rate of return on capital and risk premium, right? And all right. Some of us are sitting and saying, "Oh, my goodness, that's funny." So you must be listening to me then in the classroom and not looking at me. Okay, well, I'll be hopefully I'll be there next year, but you guys hopefully would have graduated by then. And you know why I talked to have some insider information. Apparently, you guys, by graduating from the CFVG, you nearly double your salary when you look for a new job. We had some statistics from the CFVG on that. So that it may look like a costly investment, but it's a very good investment, right? It's costing you money, and when you're going to be looking for another job, if you want to, and say, well, I have a graduate diploma from the CFVG and a master in banking and finance or MBA, you're going to be making a lot more money, so you'll be able to pay back your investment. So you people are smart. Good, 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 good on you. Okay, if there is no other question, then I think I'm going to move to the next set of slides. Number 4. All right. So what is this section about? So this time it's called alternatives to the current monetary system. So it's about 40 slides, and we're going to do 3 things. First, we're going to look at the deficiencies of the current system. We talked about it already here and there on different occasions. So The goal of this first part is going to be to organize those IDs, to list them, to list those deficiencies. And once we realize that, well, there are quite a few deficiencies, it's working well as well. I mean, if you look at the world nowadays, it's in a much better place than 100 years ago. And that's part of it is due to our banking and financial system, which is providing opportunities for people to borrow, to set up business companies, to fund the purchase of their property. So that's a lot of good things going on, right? But I just want to emphasize the bad things in order um, to motivate studying these two guys. First, free banking, which is an alternative to the current monetary system in the following sense. It's exactly the same, except there's no central bank. Right? So it's all about trusting competition to drive the banking system and credit creation. You're going to see it's very intuitive and easy to understand. And there's apparently a bit of free banking going on in Vietnam already, as I told you, because you guys, some of your banks are using the Vostro and Nostro accounts to pay each other after 3 p.m. That's free banking in a sense, but you do have a central bank, so it's not free banking. But anyway, and then we're going to talk about cryptocurrencies and in particular Bitcoin as an alternative to the current system as well. Okay, so let's proceed. So deficiencies to the current system. All right, so problem number one, introduction. Reserve banks play a central role in today's monetary system. Control quantity and the price of reserve money, right? The quantity, they have various different ways of doing that. They can play with the reserve ratio requirement, or they can buy securities from commercial banks. We've seen that on various different occasions, either through regular open market operations or through quantitative easing, or they are buying government bonds like they do in Europe. So they act on the quantity. Central bank act on the quantity. By the way, I didn't show you the ECB central bank balance sheet, but it's this. It would look very similar to the Fed in the sense that it has increased quite significantly since the 2008 crisis. And the central bank can act on the price of base money as well. We know that that's the interest rate, right? But there are several issues with today's central banks and monetary system. Let's look at them. So the first one to realize is that if you look at history, and especially recent history, all major episodes of high inflation are due to excessive money printing by the central bank. Okay. Two examples, for instance, a recent example, you look at Zimbabwe in Africa or Venezuela in South America. The only reason behind those hyperinflation is because of too much money printing by the central bank. It has nothing to do with the private sector or anything like that, right? It's just the central bank printing too much money. Why do they do that? Well, they do so because they want to supplement taxation, right? They consider they are not going to be able to fund all their expenses through taxes. So they think, well, let's print money, okay, and see how it goes. Well, if you do that once, twice, 10 times, 20 times, then soon enough you lose control over the process. And because prices start to rise, you need to print even more money to be able to keep up with inflation. So that fuels inflation even further, and soon enough you end up in a spiraling tornado of inflation, right? But the reason they do that is typically because they don't have enough income through taxes, right? Because the economy is dysfunctional, or there's a lot of black market economy going on. So that's why. Um, so money is printed to help fund the government, either directly by lending money to the government or by buying government bonds. Remember, we did an exercise on this. I don't remember which one, but um, we did an exercise precisely on this where we had the Federal Reserve, the central bank that was either lending to the government directly or it was buying government bonds. Okay, but in both cases, this translates into an expansion of M0. Right? So, problem number one, all major episodes of high inflation are due to the central bank printing too much money or having interest rates too low. Okay, and that's bad. We know that hyperinflation is bad. Hyperinflation wipes out any savings. Hyperinflation wipes out any savings in the domestic currency. That's why in hyperinflation country, people tend to have at least some, if not all, of their savings in a foreign currency like the US dollar. Because if you save in in um, in the domestic currency and there is hyperinflation, you're pretty much losing everything. So that's really bad. Just to give you an example, one year I remember one student from Zimbabwe brought me a 50 billion Zimbabwean dollar bill. Zimbabwe. I still have it. I don't think I have it with me. Uh, oh, I can look it up on internet. Mm-mm. Ah, oh, that's even more than that. That's 50 trillion. Oh, look at that. On a 50 trillion Zimbabwean dollar bill. Look, there you go. It's hard to count the zero, so it's 50 trillion, right? That tells you something about hyperinflation in this country, right? Uh, oh, zeros everywhere. Oh, 100 trillion. What's the next? What's the crazy? That's crazy. Anyway, all right. Back to class. That's problem number one. Problem number two. Key economic and financial variables should be determined by market forces rather than politicians. Yes, those interest rate decisions, those money printing, QE, government buying decisions, this is a goal. This is all driven by politicians and governments that think they understand how the economy is working and they try to fix it. But typically, as in the euro story, for instance, they're fixing problems that they have created themselves, right? So, but we can take a few examples. Look at the 2008 financial crisis. I told you Um, one of the main driving factors behind the 2008 crisis was the very low interest rate environment during the 2000 decade. And that low interest rate environment was due to the Fed decreasing interest rate massively after the crash in the Nasdaq. Remember that story I told you 2 days ago, right? There was a crash in the Nasdaq in 99, 2000 or 2001. So they drop interest rate. But the crash didn't have much of an impact, so they should have brought interest rate back up very quickly, and they didn't. So you see, that's because we had this whole credit binge and excessive credit creation. So my point is, the start of the crisis was triggered by a poor monetary policy decision, right? So it was not a market. It was not a market dysfunction. It was not the private sector that took bad decision. It was a bad monetary policy to keep interest rates for too long, right? For too long. So that's example number two. But you had a similar story in 1929. It was the opposite example. So in 1929, it all started with a stock market crash. And rather than decreasing interest rate to provide liquidity to the financial firms in trouble, they did the exact opposite. Why? Because they wanted to punish speculators. So they said, well, this stock market crash is due to excessive speculation, so I'm going to punish speculators by rising interest rate. So again, that's a bad decision, and this is not market dysfunction, right? This is just poor economic decision. And finally, that's anecdotal, but as the crisis started in 2008, the ECB decided that it's the right time to increase interest rate. So they did something similar to 1929. But they quickly reversed, right? Uh, the chairman who did that was Jean-Claude Trichet, and he was replaced by Mario Draghi, who decided to drop interest rates. So my point is, what am I trying to do here? I'm trying to to summarize some of the deficiencies of the current monetary system, right? We've seen that the first one is that all major episodes of high inflation are due to central bank money printing. Second, many of the recent crises are due to poor economic policy decisions. Okay. Third, the central bank has a monopoly over the provision of reserve money. Yeah. And that doesn't sound very healthy. Okay. Typically in economics, and I'm sure you know that. I'm sure you had that in some economics 101, which is introductory economics. Economics 101. One of the things you will learn is that competitive markets tend to be efficient in allocating resources, right? The quantity traded is maximized. The consumer surplus, the sum of the consumer and the producer surpluses are maximized. As soon as you move to a less competitive environment, and especially to a monopoly, then there are inefficiencies showing up. In particular, the price of the good being provided is too high. But here, in the case of the central bank, it's not that the price of money will be too high; that they are because it has a monopoly over the issuing of base money. There is no limit. Okay, there is no competition. There is no competition between different base money, between different reserves assets, and we're going to see that free banking is exactly the opposite. Free banking is about letting commercial bank choosing what sort of currency or asset they want to have as reserves. Nobody forces the bank to hold one particular asset as reserve. In today's monetary system, that's not the way it works. In today's monetary system, there's only one reserve asset for interbank payment. It's called base money, and the central bank has a monopoly over printing and issuing that money. And as soon as there is a monopoly, that means there are risks associated. One of them is excessive printing and issuing of that base money. All right. Yes, we know that central banks, they are not profit-driven institution nor elected institution, so they cannot be voted out or sanctioned by the market. That's something interesting to note. In the economy, there are kind of three types of institutions. There are private companies, there are that's not the economy, but there are three types of institutions. We have private companies, elected bodies, and governments. For instance, um, conseil d'administration. How do we say? I forgot how to say that. Translate. Board, I think. Yeah, board of directors. That's it. Um, private companies, elected bodies, and government institutions. My point is the following: whether it's if you're a private company and you're doing bad and you will lose money, that your shares will fall, and the company will go bust unless you appoint a new management team, right? For elected bodies, whether it's board of directors, for instance, in companies or for government, well, if they're not doing a good job, people will vote for a different government or for a different body. The problem is the government bodies that are not elected, like a reserve bank, is that if they do a poor job, there's not much punishment coming. Okay, there's not much sanctions coming. Okay, why? Because they have a monopoly. So that's another thing that I don't think is, and many economists know, consider that it's not very good. Last problem, and which we discussed already, is the fact that central banks are lenders of last resort. So it looks good on paper, right? Lenders of last resort says, okay, the bank is in trouble, and then there's going to be the central bank would step in, provide emergency lending, perhaps buy some of its assets at a higher price than when the market says it's worth. So it looks good on paper. The problem, and we know that it creates a moral hazard problem, which is when, and I think I have a good definition here, when people do not face the consequences of their action. I mean, there were many financial institutions during the 2008 crisis that did not face the consequences of their actions. Why? Because they were bailed out. You know that they're bailed out. They were bailed out, but that's spelled like this: bailed out. You're bailed out, and when you know you're going to be bailed out, well, you're probably not going to behave in the same way as if there was a risk you would go bust, right? So financial institution can take way too much risk knowing that they are going to be bailed out by central banking if things go wrong. Okay. And by the way, we're going to talk about free banking in a moment, but you could replace the central bank by some sort of insurance pooled money, right? That is all banks contributing contributing to a fund that could be used in case of emergency. Let's assume all banks they contribute towards some sort of bailout fund that could be used in case something goes wrong. There would be some strings attached, like saying, well, you can use that fund once, not twice. If you want to use it twice, that means you'll not be acting properly, not behaving wisely, right? So the idea that central banks cannot be replaced, I'm not too sure. Like uh, there's I have a one word for you. It's insurance, right? They could subscribe to some sort of insurance that could provide the liquidity in case it is needed, right? So before we move to studying the first alternative, which is free banking, I want to briefly highlight what Milton Friedman said about monetary policy. Milton Friedman wrote a very wise article in 1968. The name of the article, I think, is What Monetary Policy Can Do, something like that. Okay? And you will see it's a very different take on what people consider normal monetary policy nowadays. Here is what he says. He says monetary policy can prevent money itself from being a major source of economic disturbance. I think it's a very clever statement. Okay. Uh, so monetary policy should just provide a stable background to the economy. That is, employers and employees can proceed with full confidence that the average level of prices will behave in a known way in the future, preferably that it will be highly stable. In particular, and this is very important, the monetary authority should avoid sharp swings in policy. What does that mean, sharp swings? That means huge spikes in interest rate or huge falls in interest rate, just like the Fed did in 2001, for instance, or in 2008 and 9. So you see, Milton Friedman's idea is actually the exact opposite to what people are doing nowadays. Uh, Central bankers nowadays, especially in the West, I'm not talking Vietnam here, in the West, they act like they are God, right? They always want to drive, manage the economy, thinking they know better, right? But as I hope I convinced you, they took a poor decision in 2001 by dropping interest rate and leaving them too low for too long, and then they had to make another crazy decision, which was so this triggered a lot of borrowing. So they had a housing bubble that collapsed. So they had to, in emergency, drop interest rate again. So you see, they're creating by trying to solve problem, they're creating the next crisis, right? And Milton Friedman told us this is exactly what you should not do. What you should do is just provide a stable monetary environment by making sure that interest rate, yes, they can fluctuate up and down depending on the business cycle, but that would be mostly left to the market, right? Markets should determine interest rates rather than governments, right? Because market reflect forces, right? If the think about it, if the economy is booming, there's going to be a lot of demand for money. So the price of money will go up, and the price of money is the interest rate, right? So there are some self correcting forces in the economy that prevent the economy from overheating or from collapsing, right? Let me say that again. I'm going to answer your question or your comment in a moment. If the economy is doing very well, there's going to be a lot of demand for credit. And given the amount of base money on the market, its price will go up, so the interest rate will go up. Conversely, if the economy goes down into recession, there's going to be very little demand for base money, so its price will be very low, and therefore the interest rate will be very low. So there's already a natural mechanism that ensures that interest rate will adjust to the business cycle. So why do we need a central bank um, to interfere in that process? And that's what Friedman says. Friedman says not only it's bad, but also it makes agents' economic decision difficult because prices keep changing all the time, and in particular, a very important price, which is the interest rate. You see, so so to summarize Milton Friedman's view, and then I'm going to answer your comment. Milton Friedman's view is about meeting a central banker and telling, no, sir, you're not that important. No, sir, you should step back from the market and should just let people do their own business and provide liquidity at a very regular pace. Okay, so of course it's not very popular among policymakers because you're basically telling them that they are not really useful and perhaps even harmful, right? So it's not very popular among policymakers, but it is very popular among economists. And I think it's a very wise way of looking at monetary policy. Okay, so let me take your comment. But the role of the central bank is not limited as the last lender of last resort. They're also the regulator of the financial market. Yes and no. For instance, in Switzerland, those are two separate institutions, right? You have the central bank, which handles monetary policy, and you have, I think it's called FINMA, which is another institution which is about dealing with financial market regulation. So, of course, you do need financial market regulation. There's no doubt about that. Where you need to make sure people act and take decision in a reasonable way, right? So that's definitely true. But those are two different things. Financial market regulations and monetary policies are two different things. You can separate them, and some countries do, such as Switzerland. But it's a good comment. Second comment: they hold a role to maintain the healthy banking industry and financial markets via prudential regulation authority. Again, this is financial regulation. This can be in the same way you have the Glass-Steagall Act. I'm not sure whether that was you who raised that point. Who was it? It was you. In the same way that you have the Glass-Steagall Act that separated commercial banking from investment banking, you can separate financial supervision and regulation from monetary policy. That's perfectly possible, and many countries have done so. Okay. So I know it sounds a little bit harsh for those poor central banks. They're not really poor. Huh? They're making money by making money. We know that. But well, that's the goal of a graduate course, right? It's going beyond what everybody says and trying to go into the intricacies of how it works and realizing that, well, maybe it's not working as well as we thought, right? And in particular, I hope I was able to convince you that in many instances, at least, I'm not saying all the time, but in many instances, at least, central banks are responsible for some of the trouble, financial trouble that we are in at the moment. Okay, I'm not saying it's all the time, and there are a lot of countries that are doing things reasonably well. So, but at least you need to be aware of the risk that it can happen, and also that to the fact that it happened and it has happened. Okay. So I'm happy to take a question or two now before we move into studying free banking. In another way, the whole banking industry is building based on credit, which means trust. That's right. That's definitely right. Waiting for the rest of the comment to show up. Then if there is no central bank to be an insurer, how the private sector can be 100% trust on the bank? Well, that's somehow what I said before. We're going to come back on this, but remember what I just said here? You could replace the central bank by some sort of insurance pooled money, all banks contributing to a fund that could be used in case of an emergency. So you could create this sort of safety by making sure and forcing every bank to pay into that insurance fund. Okay, that could help in case of a liquidity crisis. Okay, and that insurance, yes, exactly. That insurance, the interesting thing that this insurance would be managed by managed by all the banks together, right? So no monopoly anymore. So that's usually that could be a good idea, at least in terms of incentives, right? No more moral hazard, right? when all financial institutions going to buy the insurance, then when the market crashed, the government still had to bail out. I know. I'm not saying it's perfect. My point here, I'm not saying I have found the solution to all financial problems. I would not claim that. Okay. The what I'm trying to say here is to show you the other side of the coin. Okay. If you listen to the media, if you listen to the press, many of them, they're always praising central banks like they're just second next to God, right? They are thanks to central bank, the world is safe, blah blah blah. Well, if you look at history, if you look at the economic and financial history, it's not exactly that, right? There are many instances in which the central bank was the prime reason behind the beginning of the crisis, and they're still doing harm. So my point is just to show you the other side of the coin, just to show you that there are problems associated with central banks. I'm not saying people are bad. I'm saying the way institutions are designed creates poor incentives. So my goal is also to show you alternatives, right? Different systems that, in a way, could solve those issues. I'm not going to claim they're perfect. I'm just going to say that they work in some way, in some dimensions, right? There might be other problems, but at least we have something that we can compare. Okay. But I'm glad you were having this discussion, and thank you for your comments. I appreciate it. It makes the class more lively and challenging also for me and for you. I got your points, Prof. Just want to say there are always two sides of the coin. Central bank got some deficiencies, but they have some reason. Yes, I guess you can say that. Um, I I suggest we get back to this discussion after I presented free banking. Because you see, it's from an intellectual point of view, at least, it's very alluring, very attractive, right? So we can we, it's going to be we're going to have more material to lead this discussion and this debate. But thank you again for your very active and very smart participation. So the case for free banking. So for those slides, I'm mostly going to read them. I might make a few comments, but I've spent quite a bit of time summarizing this, so I think there's no point in trying to reformulate it. So I'm just going to read them, and I'm going to comment after that. So how does free banking work? Right tool. How does free banking work? So in a free banking environment, banks are free to issue their own currency in the form of deposits. We know that already, but also in the form of banknotes, right? Which are liabilities for them. So it's not necessary, but it's a possibility, right? You see, well, nowadays we move more and more toward electronic money, so for the statistics show it's not really that true, but anyway, still we're using banknotes, right? In a free banking environment, banks can issue deposit. They can do that today as well, but they can also issue their banknotes. It's not critical for this story, but still it's important to know. And importantly, banks are not subject to special regulations beyond those applicable to most enterprises. What does that mean? It means there's no really specific banking regulation with a banking license and so on. It's saying, well, you're going to set up a bank just like you set up any business, right? And if you're doing good business, then your company will grow, your shares will appreciate, and you will earn an income. And if you're doing badly, you will lose customers, you will lose revenue, share prices will go down, and eventually you're gonna go bust, you're gonna disappear. And there's no central bank to save you. Okay. Well, if you think this way, then this brings a new set of incentives in the banking industry, right? And this set of incentives is about saying, if you want to do good, you need to make good economic decisions. Okay. And those liabilities that are issued by the banks, they are claims to the bank's assets. The enforcement of these claims is a matter of commercial law rather than public policy. What does that mean? It means what I was just saying before, right? Enforcing the liabilities, the convertibility of the liabilities of the bank is a matter of commercial law, which means it's going to happen if the bank is uh, doing good and was able to accumulate enough assets, right? It's not because somewhere it says that there's a government guarantee, right? Those liabilities can be turned into asset because the bank holds assets, not because the government says, I'm going to print money in case there's trouble. Let's move on. Those private monies can be convertible into the reserve asset, can be gold, can be silver, for instance. That can be anything. It can be bonds as well, for instance. Bonds, stocks, whatever. But there is not in base money because there is not any. Okay? So all those liabilities, whether they are deposits or bills, they can be turned into some sort of reserve asset. But this reserve asset is not base money. Why? Because there's no base money. So it can be anything else. It can be gold, it can be securities, it can be stocks, bonds. So banks could pay each other with this sort of reserve asset that is not base money. They could even pay each other with their own currency. We're going to see that in a few exercises. And by the way, Vietnamese banks are already doing that. This Vostro and Nostro account we talked about, that's exactly what it is. Banks are paying each other with various different currencies available on the market, right? Various different banks' currencies. So they can issue their own deposits already. They cannot issue their own bills in Vietnam, but you can issue deposit for other banks in Vietnam. So those private monies are convertible into some reserve asset, and they trade at some market-determined exchange rates. That's not a necessary feature of free banking, but it's nice to think of free banking in terms of free floating currencies, right? In a sense that, well, there's an exchange rate between banknotes and between bank currencies that is determined by supply and demand. Take the following example. Assume Vietin Bank is doing a much better job than Vietcombank, right? And there's no central bank, it's a free banking environment. So if Vietin Bank is doing much better, which means lending money to good businessmen that are making quite a bit of money, whereas Vietcombank is not very careful and lending to crooks and to people that will not be paying back their loans. So in this environment, people will know that eventually because there's financial information provided, and people will be nervous banking with Vietcombank because they know they're not making very good decisions. So perhaps they should be moving their account to Vietinbank. And if they do that, there's going to be a higher demand for Vietinbank money and a higher supply for Vietcombank money. Therefore, the price of Vietcombank money is going to go down and the price of Vietinbank money is going to go up. So you see, it's perfectly possible to have a market-determined exchange rate between those different bank money in the same way as the forex market. In the forex market, the price of the US dollar versus the Japanese yen moves every day according to supply and demand. But you would have the same, but within your own country, within Vietnam, you would have the Vietin Bank Dong and the Vietcombank Dong, and all other banks would have their own dong in a sense. Okay? So you may think, well, it's a bit complicated what you're explaining here, what you're describing as a system. Let me tell you, first of all, this existed in a history 200 or 300 years ago when people had way less technology than nowadays. It would be a lot easier to do that nowadays with your smartphone, right? You would log in into your smartphone and check the value of the different dongs, right? Wow, the Vietin dong is going up. I was right moving my account from Vietcombank to Vietin bank, right? So it will all be determined by supply and demand. So if you're doing well as a bank, people will try to bank with you, will try to do business with you. So this will drive up your customer base, this will drive up your income, and this will drive up share prices. Everybody will be happy. And the poor banks, they're going to lose customers, they're going to lose income, and share prices will go down. Look at me. I said I would be reading my slides. I cannot do that. I'm always talking. But I think was a good way of saying things. So any bank issuing too many notes would find them deposited into other banks. Sorry, oversupplying its currency would then translate via the interbank clearing system into a costly loss of reserve, a depreciation of its notes relative to other banks' notes, a combination of one and two. Okay, so it is all driven by market mechanism, by supply and demand, right? Therefore, private currency insurers face incentive for quality control and good management, or faces the cost of losing customers, right? If Vietcom Bank, in my example, does not take very good decision, people will move their account to another bank. Therefore, Vietcom Bank stocks will depreciate because they're losing customers and incomes. The shareholders will not be happy, right? They say, what's going on? Everybody's leaving for Vietcom Bank. What's going on? And if you don't change the way you're doing business in this bank, you eventually go bust. Too bad. Okay? But if you're customers and you're being careful, you're gonna try to be aware of that. Right? Just like when you buy a car or a motorcycle, I'm sure you make a little bit of homework trying to see whether it's a good car or a good motorcycle. Same when you buy an apartment, you're gonna look at the neighborhood, you wanna have a quick look at the neighbors if you can, the quality of the building. So you do a lot of research, you do a lot of homework to try to see whether it's a good apartment, right? How's the plumbing, how is the insulation, environmental norms, everything. So you do your homework, you do your research. Why wouldn't you do the same for your bank, right? You would do the same. So this is perfectly possible. So I can see someone was typing. Shall I wait for? I'm gonna wait for the question to show up. Okay, nothing coming up, so I guess I'm gonna move on. So to summarize, so free banking, well, you have no central bank, therefore no base money. You have no lender of last resort. You can replace this with some sort of insurance pool. There's minimal regulation on what bank's portfolio should look like. They can hold and pay what a reserve asset. And with or without a reserve asset, I'm gonna come back on this in a moment, but we're gonna make exercises. I'm gonna show you that you don't really need a reserve asset actually. You don't need base money, obviously. If it's free banking, there's no base money because there's no central bank. But you don't even need a reserve asset in the sense that if banks are happy to hold some other banks' currencies on the asset side, then it's fine. They can pay with other banks' currency. You see, it's like Vietcom Bank paying with Vietin Bank's currency rather than its own currency. We're going to make an exercise. It's going to be clear for you. So that's why free banking is equivalent to monetary laissez-faire. So laissez-faire is French and from the French language, and it's one of those words that the English have stolen from us, just like the ring. Laissez-faire, what does that mean? Laissez-faire means let go. How that means let go. So means free, right? So it's yeah, monetary freedom. You could translate it this way, I guess. let do. Okay, some prominent economists defended free banking, such as Adam Smith or Friedrich Hayek. And if you look at history, we had more than 60 episodes of free banking, including in Scotland from nearly 150 years, right? From 1719 to 1845 in Scotland, they lived in a world of free banking. And they didn't even have all the electronics that we have today. You had different banks, they had their own bills, and you had exchange rates between those bills. And that was the way it worked, right? Same in the US, Switzerland, Australia, France had a very short time of free banking at the beginning of the 19th century during Napoleon, I think. Canada and Sweden, right? Free banking. Banks are free. Today's highly computerized economy makes free banking much easier to implement. As I said, you could just look at your iPhone and say, you could look at the value of all the bank's currencies. And by the way, you could bank with different banks, right? Nobody forces you to have only one bank. You can diversify and be banking with Vietcom Bank, Vietcom Bank. Could you please give me another bank's name because I keep using these two? That's a bit embarrassing. I would like another Vietnamese bank name, please. What else do we have? Vietin Bank, Vietcom Bank, something that I can pronounce as well. Techcom Bank. Thank you. Techcom Bank, that would work. Okay. So you see, you can have an account with Vietin Bank, with Techcom Bank, as many accounts as you want. It's up to you. You can diversify, just like when you invest in the financial market, sometimes you want to diversify. All right. Contrary to popular beliefs, free banking was not especially unstable or subject to crisis. Yeah, people criticize free banking by saying, "Oh, this is dangerous, this is risky." That was not really the case. And if you look at history, and researchers have done that, the end of free banking in the US, for instance, was due to, oh, guess what? Government intervention. What a surprise. Yes, in the US, for instance, banks were forced to back their notes with high risk state bonds that depreciated rapidly. So, yes, people don't know that, but the reason why free banking eventually disappeared and faded is because the government forced those free banks to hold one particular type of reserve asset, and that reserve asset was state bonds. That is, bonds issued by the state of Mississippi or North Carolina or whatever. And some of those bonds were not very good bonds, so they depreciated rapidly. Therefore, the reserves of the bank depreciated, so the bank went bust because of that. It's not because of poor decisions. By the way, here I'm not saying in the banking, in the free banking environment, all banks will do extremely well, will be very safe, will be very secure, will take very good decisions. No, that's not what I'm saying. Some banks will make poor decisions, some banks will be crooks, and they're gonna go bust, and customers will lose money. Yes, but first of all, that's not the majority of banks, it's just a tiny fraction. And second, I mean, it's up to you. If you don't do your homework and not being careful with who you're banking, then well, eventually you're gonna lose. Right? Just like if you're not very careful when you buy an apartment, right, in a very noisy and polluted area or whatever. Well, that's I'm sorry, but that's your fault, right? It's not because of the guy who sold you the apartment. You should have been careful not to buy there or to ask for a big discount, right? So yes, the point I wanted to emphasize that the end of free banking was not really due to because it was a bad system, unstable. One reason, at least in the US, was because of government intervention, forcing banks to hold state bonds. And the second, and that's interesting, we know that central bank make money by making money. We know that. It was yesterday's very good joke. So do you think they want to let that go? Do you think those central banks that are making money by making money want to let this privilege go? You really think so? And a lot, at least in US, a lot of that money goes back to the treasury. Remember that, right? Among the 96.4 billion US dollar that the Fed generated as signal income in 2014, I'm pretty sure 80 or 90% of it went back to the treasury. Do you think those guys would let this income go just like this? Exactly. That's the Lord privilege. The Lord does what he wants, okay? And we are poor parents. We are poor workers, and we can just abide by what we are being told to do. Okay, well, that's not the way I think, and that's not the way many economists think, and that's not the way Milton Friedman was thinking, for instance, right? Uh, that's the other side of the coin that I'm showing you right now. I'm not saying this is a perfect world. I'm just saying perhaps we've gone too far in government control, right? Perhaps we've gone too far in government control of money. Here I'm describing a system that, in many people's view, would work just fine, with some risks with associated, that's for sure, but they will work just fine. All right. A summary paragraph written by a nice, smart lady called Vera Smith in a book called The Rationale for Central Banking and the Free Banking Alternative. I'm going to read that. Free banking is a regime where not issuing banks are allowed to set up in the same way as any other type of business enterprise, so long as they comply with the general company law. The requirement for their establishment is not special conditional authorization from a government authority, but the ability to raise sufficient capital and public confidence to gain acceptance for their notes and ensure the profitability of the undertaking. Under such a system, all banks would not only be allowed to the same rights, but will also be subjected to the same responsibilities as other business enterprises. If they failed to meet their obligations, they would be declared bankrupt and put into liquidation, and their assets used to meet the claims of their creditors, in which case the shareholders would lose the whole or part of their capital, and the penalty for failure would be paid, at least for the most part, by those responsible for the policy of the bank. No bank would have the right to call on the government or on any other institution for special help in time of need. Highlighted, no bank would be able to give its notes forced currency by declaring them to be legal tender for payments. Okay, so that's a good summary. I like it. So I suggest I'm happy to take a couple of questions now before we move. I have prepared two exercises. So this one you already have it in your slides, but I've added a second one this morning. So we're gonna do it after. Okay. So any question at this stage? Now that you have a better idea of how the free banking system works. So we can see that some of you are typing, so I'm waiting for the questions to show up. What's new and different from this free banking concept compared to the recently learned sessions about banking system? I'm sorry, I want to make sure I understand your question. You mean what is new, what is different between free banking and the regular banking that I explained at the beginning of this class? Yes. Well, one big difference. Who wants to answer that? One big difference. Waiting because some of you are typing. What's the big difference between free banking and today's banking system? Because most all the exercises that we did so far were for the regular normal banking system that we know, that we work with every day. This new thing that I'm introducing now, which is called free banking, has one main difference. What is it? So that's a question I'm asking you. All right, I think I'm going to answer because the answer is not coming. It's there is no central bank and therefore no base money to be used as reserve and for interbank payment. Okay? That's the main difference, but it's a key difference. Right? Why is that? Because to, sorry, in today's banking system, this reserve asset can potentially be provided in an infinite amount. And I've shown you what happened in the US. Right? There was a massive increase in the bank's balance sheet of the Fed, and same for Europe. Why? Because central banks can print as much base money as they want. In a free banking system, it's impossible. There is no central bank, and therefore there is no way to print too much base money. Banks will pay each other with another type of asset. As I said, it could be gold, it could be bonds, it could be stocks, it could be whatever. They could also pay each other with their own currency, like you guys do with your Vostro Nostro account, right? Did I answer your question? I guess yes. uh, it's not a clear yes, so I guess there are some remaining uncertainties. Perhaps I suggest we do some exercises and that might answer your question. And if not, feel free to come back to me with the same question or a slightly differently worded question. Okay. So first exercise. Oops, here it is. The banking system is now one of free banking in the way I've just defined it. So two questions. Represent the simplified balance sheet of a bank in a system where banks hold and trade gold as reserve. All right, that's question number one. Question number two, represent the simplified balance sheet of a bank in a system where banks hold and trade other banks' liabilities as reserve. Okay, so that's the two systems I was talking about. Right? I told you, either banks in a free banking system, because there's no central bank, there's no base money, so they have to find some other asset to pay each other, right? Option one, and that's question one, they use some asset, and I told you gold here in the example, right? Option two, they don't use any asset, they just use other banks' currencies, other banks' liabilities to pay each other, okay? So what I want you to do is to draw a representative balance sheet in that case for a bank and for a bank in that second case. Okay, is that clear to anyone? All right, then I'm gonna create breakout rooms. I think 8 minutes would be enough. So 4 minutes for, let's say 3 minutes for the first question and 5 for the second one. The second one is a bit more tricky. So I'm gonna create breakout rooms. Here we go. 8 of them, 8 minutes time, randomly assigned. And here we go. All right, welcome back. So, uh, who wants to answer the first question? Right. Okay, so asset gold plus loan, liability banknotes. Yes, that's right. Good. But it's not only banknotes, right? Banknote is one part of the liabilities. It can be deposits as well. I'm going to prepare for question one. Oops. Assets. Liabilities. Okay, other assets reserves or gold liabilities. My banknotes plus gold. Nope. Gold is necessarily an asset. It cannot be a liability. I'm going to come back on this if you want. Asset reserve asset as gold. Liability banknote deposit. Yes, yes. That's. I guess the simpler way would be like this. Okay, so you have gold as reserves. Okay. Then you would have some loans. And obviously also some securities. It's like your regular bank. The only difference, obviously, being that gold uh, is the new asset. In terms of liabilities, we would have two things. We would have the bills first, banknotes, and the deposits as well. Right, so the difference with the regular banking system, there are two differences. The first one is that now you don't have base money anymore. As an asset, you have gold. Okay, so and that means because there's no central bank cannot produce gold, right? That means this asset cannot be produced at will, cannot be produced indefinitely. Okay, so its price going to fluctuate according to supply and demand, not according to a monetary policy decision. Okay, and the second difference, although it's not as important, is the fact that now commercial banks can issue their own banknotes. They still can issue deposits. We know that. There's no reason for this to change, right? They can issue deposits, just like in today's monetary system, but they cannot issue banknotes in today's monetary system. In free banking, we can assume they can. But again, it's not really important. I mean, we can perfectly do away with that. We could perfectly build a free banking system without banknotes because so many of our transactions nowadays are done using electronic money that we can really do away with banknotes. So you could really have a free banking system without banknotes, right? The key difference is in the fact that the reserve asset is now a regular asset, not something that can be printed infinitely by the central bank. Okay, is that good for everyone for question one? I'm going to come back on Mr. or Mrs. answer, which says for liabilities. Um, you say my banknote, so yes, that's right here, and gold. And no, gold is not a liability; it's an asset. You see, remember what a balance sheet is. Huh? On the asset side, you have what you own, and on the liability side is where it's coming from, right? Your liabilities. So. uh, gold can only be an asset. A liability is a recognition of debt in a sense, right? A liability is a commitment. Uh, you acknowledge that you owe something to someone. So gold cannot be a liability in that sense. Am I making things clear here? I'm trying to answer the comment by um, Han. I'm sorry about the pronunciation, which was saying that gold was showing up as liability. No, gold is not a liability. I want to answer the last comment. In what is the unit of account in this balance sheet? It's well, the unit of account of your country. So it could be dong. I would say dong. I guess your question is because you have different. I think I get it. Because you have different currencies, what currencies are you using to draw your balance sheet? I guess that's your question, and that's a good question. Well, it's a good point. So let me clarify this. Assume you have Vietin Bank currency, Vietcom Bank currency, and Techcom Bank currency. Um, you could choose one of them, your own, for instance, and decide to use your own currency for the unit of account. Okay. Or you could say you could use a fake unit of account, right? That could be used by any bank, for instance. I don't know. Account. We're gonna call it the accounting dong. Accounting dong, which is the unit of account, right? In which, for instance, well, if you set it up like it's equal to one dong of Vietin Bank, and therefore, because your own currency fluctuates, you know the exchange rate with the accounting dong. Okay, so it's really not a problem. I'm not sure I'm making myself clear here, but you can choose some sort of common unit of account in which you would convert your own currency into that unit of account and then register and record the transaction into the unit of account, or doing it into your own unit of account. Okay. Right. Did I answer to the goal? Okay. So I'm going to do the other one now, unless there is a question from one of you. The question two. Assets and liability. All right. So who wants to answer question two? I'm going to use a different color. I'm asking you to represent the simplified balance sheet of a bank in a system where banks hold or trade other banks' liabilities as reserve. Tricky question. When a customer brings a new deposit to Bank A in terms of Bank A is not, then which part of the balance sheet will be impacted? Well, actually, that's my next exercise, young lady. So if you don't mind, we're gonna leave that to the next exercise, okay? That's a good question. Uh, so I'm going to answer that part. Um, so, well, unless someone wants to answer it. So someone is typing, so I'm waiting for the question to show up, to the answer. So two banks, these note, yeah. Plus loan plus security, yes. Banks is notes plus deposits plus liability. So indeed, you're gonna have let's put it other banks currencies. Okay. So bank A, you can hold bank B's deposit at bank B, for instance. You can have some loans as well, or as always, this doesn't change. You can have some securities as well. That doesn't change either. In terms of liabilities, you're also going to have your own banknotes, obviously. And you're going to have deposits as well. Okay, we can distinguish between by customers. Oops, that's too small. By banks. Why? Because now other banks can make deposits into you. Okay. If as a bank here, my deposit is an asset. Okay, when you say other banks currency, that means the deposit that I have in other bank in this format right there. Okay, so that's for question two. Okay, is that clear for everyone? So if I look at your answer, Mrs. Banks not, you're right. So I've written other banks currency because it's not only notes, right? It's anything from other banks. So it would be notes and deposits. Deposit of the banks. Okay, that's too small again. Notes, but mostly deposits out of the banks. Okay. Right, and in terms of and on the liability side, you're gonna have a deposit, obviously, yes, your own notes, and deposit by customers and by banks. Okay. Do you have any question? We're gonna do another exercise on this, but this is important to set the stage. Is that all clear? So let me briefly comment, then if there's no, oh, I can see someone is typing. I'm waiting for the question or the comment to show up. When do we need to separate between banks, notes, and deposits if they are both promissory notes of a bank? Well, they're both liabilities. They are both commitments. The only difference I would see is that, yeah, I'm just finishing, Eileen, I'm just finishing this and start over at one. Sure. I'm just finishing this, so a couple of minutes and we're going to be good. And yeah, the only difference is that notes are physical objects and that deposits are electronic money, right? That's the only difference I see at this stage. Okay, they are both commitments. So, all right, you see. Good. Okay, very good. So I think we're going to leave it there because Lynn wants you to have enough time to have lunch, and I agree with that. So I'm going to stop here and we're going to reconvene in an hour and a half. All right? So enjoy your lunch and talk to you soon. All right. Welcome back, everyone. I hope you had a nice dinner. So let us resume this session on alternatives to the current monetary system. So we are in the process of studying a very interesting system which was in place in several countries around the world a couple of 100 years ago. Right, it's called a free banking system. Keep in mind, by the way, that central banks were invented or set up relatively late, right, in the banking history. We've talked about the history of money. We haven't talked about the history of banking. It's actually older. The history of banking is actually older than the history of coins per se, in the sense that you remember when I talked to you about Egypt and Mesopotamia. Well, they were paying with pieces of silver. They had various different other medium of exchange, such as barley or copper or all sort of things. Well, you could register deposits at banks in gold, right? You could in the temples, in the palaces, also there was some sort of accounting going on in which you could register when people were making payments and when they had to make a payments. So you had this sort of accounting going on a long time ago. So the very first banks are actually very old. They are very old. Then they disappeared after the fall of the Roman Empire, and they reappeared in 12th century Italy, as we discussed. Why I was saying this? Because yes, because central banks are quite late coming into it. So the first one I think is the Bank of England, and I think it was founded around the late 17th century, right? Like 1694 or something like this. The Banque de France, early 19th century or sometime during the 18th. And the Fed was set up in 1930, right? Federal Reserve was set up in 1913, so it's very new. So if you look at the history of banking, actually, it's been a world of free banking for most of the time, and it's only very recently that central banks came into the picture. Okay, so it's worth keeping that in mind. All right, before we do the next exercise, I want to discuss a few important differences between those balance sheets and the one we've been working with so far. So if you look at question one, what we already discussed it, what we see the difference is the fact that we have gold as reserve now, and there can be some banknotes. If we look at the second question, in case banks are holding and trading other banks' liabilities as reserve, you can see that the reserve assets is the currency being issued by the other banks. So if it's bank A, if for instance, if this is bank A, then it would have on the asset side bank B's currency, bank C's currency, bank D, in the form of banknotes, as some of you pointed out, but most likely as in the form of deposits at bank B's, at bank C's, right? Which is exactly what you have here. All right. So if this is bank A, that would be deposit by banks, like bank B, bank C, bank D, and so on. Okay. So you see the difference, and also the banknotes in case there are banknotes circulating. So you see the difference. I don't see any reason why this wouldn't work. And as I said, most of history was actually free banking, right? So to make sure this is very clear for you, we're going to do one last exercise before we move to Bitcoin to solidify your knowledge about this. And it's not only because I think free banking is interesting, it's because when you do this sort of exercise, this sort of mechanics in your brain, it deepens your understanding of the current system because you know what the alternatives are. You know how it could work differently. So that makes it a lot easier to fully grasp the working of the current banking system, which in a sense is simpler. I can acknowledge that. All right. Do you have any question at this stage? Because otherwise we're going to move to the next exercise, and I want to make sure that this is all very clear in your mind. All right. It doesn't look like there is any additional question. So let me go through the exercise with you before I give you time to answer the questions. So it's exercise number 8. So as I said, this was not on the original set of lecture notes. I've added this exercise this morning. I thought it would be a good idea. So I think I've shared. Let me check that. No. Okay. I'm gonna make it available for download. Right. So now you see you have this little arrow here. So you can download this set of slides if you want, so that you have a trace of this exercise that is not just in the form of audio recording. But that's the only difference with the original uh, section 4 slides. All right. So let's read this exercise together. So we have a banking system that is now one of free banking, okay, with many banks A, B, C, etc. We're going to take two banks, A and B, with the following balance sheet. So let's have a look at those balance sheets. They're right here. Okay, so we have bank A, we have bank B. Okay, no central bank. Obviously, this is free banking. So bank A has some bank C's currencies and bank B's currencies as assets, right? As you can see, Bank B's currency is 40, is exactly the deposit by Bank A, right there, showing up as a liability for Bank B, right? Because this is Bank B's currency. So that's consistent. I don't have represented Bank C here because we don't need it for our exercise. Okay. So we have Bank A has some Bank C's currencies, some Bank B's currencies. There's still a loan portfolio and some securities. We know that. Some deposits by customers and some deposit by banks. A total of 50K. Okay, and this can be split into deposits by Bank C and deposit by Bank B. Okay. Those are the Vostro and Nostro accounts we talked about. Okay, if we look at Bank B, then it has some Bank C's currencies, some Bank A's currencies, loan portfolios, securities, deposit by customers, deposit by banks. And again, if you look at the detail of the deposit by banks, you have 10Ks for Bank C and 40Ks for Bank A, with a grand total for both banks of 250K. All right, if you go back to the exercise, suppose that at the end of day one, the total electronic payments from Bank A's customers to Bank B's customers equal to 10,000, and total electronic payment from Bank B's customers to Bank A's customers equal to 20,000, so that Bank B owes 10,000 to Bank A. So remember, that's the first exercise. We also assume that the exchange rate between all banks' currencies is 1 for simplification. I told you it's not necessarily true, and but I guess perhaps I can make a quick parenthesis here. If the exchange rate is freely determined, and the value and exchange rates will change according to supply and demand. If the exchange rate is fixed, and then it is mostly is adjustments will take place mostly through interbank payments rather than exchange rate variation. There's always a price for anything. So what I'm trying to say that assumes that a bank that is always in deficit, then there's going to be an oversupply of its currency, then the value of its currency is going to fall, right? If there is no freely determined exchange rate, then this sort of adjustment will only take place through quantity adjustment rather than price adjustment. Okay, so that's my point. That's what I wanted to say. There cannot be any adjustments through prices. So it suggests that Bank B's reserve will run out. The banking debit will run out quicker if there is no freely determined exchange rate. But for the purpose of the exercise, you don't need to care about this because we've assumed for simplicity that Bank B's currencies, 1 unit of Bank B's currencies trade at 1 unit of Bank A's currencies trade at 1 unit of Bank B's currencies trade at 1 unit of Bank C's currency, etc., etc. Okay. So you have two questions here. Question number 1: record Bank B's payment, and we know that Bank B is in debt. record bank B's payment to bank A, assuming bank B uses bank A's money to pay. Aha. Assuming bank B uses bank A's money to pay. That's the first option, right? Bank B has to pay. It can use bank A's money. Or, and that's question number two, record bank B's payment to bank A, assuming bank B uses its own money to pay. So you see, question one is about bank B is going to pay with another type of currency than its own, and I've assumed it's bank A's currency, but it could be bank C's currencies as well. Right? And the second question, I'm asking you to work out the balance sheet in case bank B, rather than using one of its reserves, so bank B has to pay. Rather than using one of its reserves, it's going to use its own currency, right? How is it going to work? Okay, so you're gonna need a bit of brain power here. It's not that difficult, but I want you to think about this. Okay, the central bank has disappeared. There's no base money, so it's slightly more involved, but it works fine. And actually, as we will discuss after the exercise, that's apparently the way things work in Vietnam after 3 p.m. I told you that story already. One person, I guess 2 years ago, attending this class was working at the central bank liquidity or interbank department, whatever, and he told me that. He told me. He told me that banks are using base money for interbank payment up until 3 p.m. Then they move to Vostro and Ostro accounts. It looked up, what's this? It looks like there was an interruption. Can you hear me? Good, good. Excellent. Thank you. It looks like there was a connection problem at some point, but it's over now. So yes, as I was saying, apparently after 3 p.m., because this base money interbank payment facility is closed for the day, banks open for store accounts, and this is settled the next morning. That's my understanding, but we can talk about that after the exercise. Maybe some of you has additional information on this story or complementary information. All right. So, do you have any question on this exercise? Is it clear for you, or do you want me to clarify something? All right. Then, if there is someone, two persons typing, so I'm going to wait for the questions to pop up. Can I see the T-balance again, please? Yes, you can. Here they are. But you can remember you can download the presentation by clicking right there. If you click here, I think you can download this modified set of slides. All right, you are very welcome. So it looks like there is no question. So I'm going to let you do this exercise. I'm going to give you 10 minutes. There are only two questions, but it needs you're going to need to do a bit of thinking. Not too much, perhaps. We'll see that. And so I think 10 minutes is a good time. So I'm going to organize some breakout rooms. 8 of them, 10 minutes, and randomly assign. All right, there you go. Right, welcome back. So, um, so here we are. We have two banks. They are both holding currencies from other banks as reserves. And the first question was, so we have a payment coming from bank B to bank A's. Okay, in the first question, we're going to assume that bank B uses bank A's money. So, first answer, bank B asset bank A. Um, so this is bank B, right? So you say asset bank A minus 10K deposit. That's correct. That's correct. That's good. So I'm gonna do this first operation. Okay, I'm gonna do that in red. So we have bank B that has to make a payment to bank A because the net difference between customers from bank B to customers from bank A and vice versa is positive. Okay, so we're gonna start with the easy part. We're gonna put minus 10K here for the payment because the customers you can see that their account is decreasing, and this is going to land on the customers in bank A. All right, so that's why we're gonna have plus 10K here. Okay, well, that's the easy part. Now the question is, how is Bank B going to pay? We've said that Bank B is going to pay using the Bank A's currency that it has accumulated. So we can see that Bank A's currency is sitting here, right? So we're going to have minus 10K here. All right, because it's using Bank A's currency. And how do we balance this here? Well, we're going to balance this because we know that Bank B is using Bank A's currency, and Bank A's currency is a liability for Bank A, so it's right there, okay? And Bank A's currency held by Bank B is right here, so we're going to have minus 10 here, okay? Minus 10K. Oh, this is balanced, as you can see now, we're good. So we have 210 here. Oops. And we have 30 for Bank B's account at Bank A. So the grand total for Bank A hasn't changed. However, it has changed for Bank B, obviously, because there is less. There's some money flowing out of its balance sheet. Okay, so we have 190 Ks. Okay, and here we have 30 Ks. So, oops, that. So that's down to 240K. Okay. Look at your comments in a moment. 140K. All right. So to summarize, so there's this interbank payment going on. So there's money on the deposit side. I'm not going to use red. I'm going to use something else, like green. The easy part is this, right? You have a transfer of deposit from bank B to bank A. Okay. The other part is the payment. I told you it's going to use bank B is going to use bank A's currency, so it's going to have to use some of its currency here. It's going to decrease, which means it's going to decrease the liability I haven't put the total here, which is going to decrease the liability um, of bank A's because it's destroying, in a sense, the currency that bank A has issued, right? So let me finalize this. So we have plus, oops, I don't want green, I want red, 210 Ks, 40, 30 Ks, okay? I was saying, um, paying with bank A's currency for bank B means has less bank A's currency, and that means less liability being issued by bank A. Okay, so let me look at your comments now. Bank. So I think the first answer was correct. So bank B assets bank A minus 10. That's right. Deposit minus 10. So good. But I think bank B or bank A. So liability of bank B must increase. Nope, that's the second question, right? So deposit by bank A at bank B must, so deposit by bank A at bank B must increase. You will see that that's the second question, I think. Okay, so I'm answering this comment, the second comment. What you're suggesting is correct, but it corresponds to the second question, in which bank B pays with its own money. Now, the first question is bank B pays with bank A's currency. Okay, so that's different. All right. I can see that you're typing, so I'm going to wait for your comments to show up. I guess the last comment is similar. It corresponds to the second question. What I'm trying to illustrate here is that there are various payment options, right? Bank B asset, no change. Deposit by customers minus. Yes, that's correct. And that, yes, that's correct. It is correct. But but this is the answer. Second question. Um, as I was saying, there are two ways, several ways for Bank B to pay. It can use its own currency, and that's what you're telling. But the first question is not about using its own currency. It's about using some of the other bank's currencies that it accumulated in the past. Okay. Okay, I see. Thanks, Prof. You're welcome. All right. So before I move to question 2, do you have any question on this question 1? Is everything clear to you? So the interesting thing to notice is that I think by contrast to the regular banking system in which they would be using base money, Bank B's balance sheet has also shrinked, and Bank A's balance sheet has not increased, right? And the reason is because there's just a change in the composition of its liability, right? Rather than paying with base money, banks can now pay with their own money. And that's what you have here, right? Bank A had issued some of its money. It was sitting on the asset side of Bank B, and now that that money has been used, so its liability have decreased because of that, but they increased because of the payment between customers. Okay, so that's an interesting point to notice. By contrast to the regular case with base money, is that Bank A's balance sheet has not increased. right? I think it would have in a regular case because we would have reserve plus 10. That's why, rather than liability minus 10. Okay. I can see that someone is typing, so I'm gonna wait for that. Make sure you have it clear because I'm gonna clean the slide to do the second question. So make sure you wrote everything down. Okay. So my question for Q2: why does Bank B use Bank B? Okay, we're gonna do question 2 in a moment. I just wanted to highlight a few points here. Okay, so unless you want me not to, I'm gonna clean this slide. Okay, to answer question 2. So there you go. So question B. Um, so it's the same. Bank B has to pay Bank A because that's what the customers want. But this time it's going to pay with its own money. So we're going to start with the easy part, right? Minus K on the deposit. That's going to land on Bank A. So plus 10K uh, plus 10K on the deposit side, right? However, this time Bank B is not using Bank A's currency, so it's not doing anything there. It's not playing with its asset side. It's playing with its own liability, right? Because it is paying its own money, so it's going to increase the amount. It's going to credit the Bank A's account, right? So we're going to have plus 10K here. Oops. Okay, plus 10K. So you see we have minus 10 plus 10. All right. So where does this money land? So we're talking about Bank B using its own currency. So there you go. That's where you have Bank B's currency on the asset side of Bank A. So we're gonna have plus NK. All right. So I'm gonna draw the lines to make it rigorous, like this, like this. Total amount we have increased. Okay. And here no change. All right. So that means we have here 210, and therefore 260. 160K, 160K as well. And here the amount of Bank B's currency held by Bank A has increased from 40K to 50K. Right. As for Bank B's, well, it has a little bit less customers deposit. Oh, that's not going to be big enough. So that's going to be talking 190K, but a little bit more of its own money circulating because it has credited Bank A's account, because now it's up to 50K with no change on the total balance sheet. All right. So let me go back to your comment. My question for Q2: why does not Bank B use Bank B? What do you mean by CCY? What does CCY mean? All right. My question for Q2: why does not Bank B use Bank B's currency to pay? But that's what we've done. Do you agree with that? That's what we've just done. Bank B is paying with its own currency. You're okay, good. I want to make a comment before taking a question here, so I'm going to change my color. Okay. So you remember from the previous question that I think it was Bank B's currency, that Bank B's balance sheet that shrank because it was using some of the existing liability from bank A to pay. So its balance sheet shrinked. Okay. Here it goes the other way because bank B is issuing a bit more of its own money. You can see it right there. It's issuing a bit more of its own money. So that means that there's a bit more assets in the economy circulating. So that's why now we're moving from 250 to 260. In the previous example, one balance sheet dropped from 250 to 240 because Bank B used an existing liability to pay. And because it used it to pay Bank A, it reduced the amount of liability that Bank A had circulating. So that's why the balance sheet shrunk. Here it's the other way around, right? It's Bank B issuing additional liability, issuing more of its own currency. So that's why we see in question two, Bank A's balance sheet increasing. Okay, so yeah, that's the whole exercise. So as you can see, so perhaps I'm going to take a question maybe. I can see that someone is typing. With same amount, if pay by Q1 destroy money. Question one. Destroy money. Exactly. That's a very good comment. Very good comment. Excellent. That's a Nobel Prize of the day for you, sir or madam. I'm not sure. Very good comment. In the first question, money was destroyed because some of Bank A's liability went back home in a sense. Huh? In the second question, it didn't work out this way. It's Bank B issuing its own currency. So it's actually a very good comment. Thank you for pointing that out. All right. Any other very good comment or very good question also, or shall we move on? All right. It looks like no more questions, so we're going to move on. So perhaps a few comments before to summarize our story on free banking. So as you can see, at least from a technical accounting point of view, it works perfectly fine. Okay. The only problem is what happened if there's trouble around here, right? Which means the assets that are being used to pay are insufficient, right? Or that's one problem. Or if Bank B trying to pay with its own currency doesn't please the other bank very much, right? If Bank A says, well, Bank B's currency, it's not the best thing on the market to hold at the moment. I can have something else. Then that becomes a problem, right? So yeah, that's free banking. Free banking is all about either using some sort of special asset as a reserve for payment, like gold bonds. I told you in the US they use bonds at some point, or using the bank's own currency. What I like about using the bank's own currency, it's very clear, right? Um, there's some circulating monies around. You can issue your own. And okay, so but the main problem I suppose is the one related to lender of last resort. But as I said, it's you can fix this by organizing some sort of common pool of money, some sort of insurance to help banks that are in difficulties. So as with everything in economics, you have to how do I put it? um, compare the cost to the benefit, right? And there are a lot of costs with having a central bank. They don't talk too much about it in the media, obviously. I talked about it, right? Um, so that's why it's interesting looking at all the systems. The free banking system, that's the other one. Everybody criticizes it by saying, "Oh, it's bad," blah blah blah. But there are a lot of good things going for it, right? Competition, forcing banks to be careful in their lending policy, in their investment decisions, right? Forcing, in a sense, customers to be also careful with which bank they want to bank with, right? So it has all sorts of benefits as well. So when you think about which system you think is best, well, you have to compare the cost and the benefits. Okay. And in my view, but that's a personal view, you may disagree with that. I think nowadays is a good time to implement free banking because the technology is available, right? With internet now we can do free banking very easily. Think about those Scottish people who were doing free banking in the 18th century. They were very brave, right? But nowadays it would be so straightforward. Just like when you look for the Vietnamese dong exchange rate against US dollar, you can. This is instantaneous. You can get that information very quickly. We could do the same for internal currency, internal banks currency, and that I think that would be interesting. I'm not aware of any country doing that, so but that doesn't mean it's not good. Okay, well, if you don't have any question on free banking, I think I'm going to move to Bitcoins now, or cryptocurrencies. Okay, so um, that's the second alternative we're going to study today. And we're going to start by reminding uh, what are the problems of today's money. Not the central bank this time. I criticized central banks a lot previously for good reasons. Now I want to show you that cash may not be, and even electronic money as we know it, may not be the best way to the best medium of exchange. Okay. So in order to understand Bitcoins, which is the first cryptocurrency, let us first recall some of the problems of today's money. So for cash, there are a few problems or frictions that slow it down. First of all, to pay with cash, you need face-to-face meeting. I'm going to do the problems of electronic money right after. If you look at next slide. Okay, problems with electronic money. Here I'm focusing on cash. If you want to pay with cash, you need face-to-face meeting, right? You will not send bills through the mail. You cannot do that. You can do it with electronic money, but I'm not talking about electronic money. I'm talking about cash, banknotes. So you need face-to-face meeting, and that could be a problem. That can definitely slow things down. It's also slow because, well, you need to go to an ATM machine, pick up some cash, store it in your wallet, put your wallet back into your pocket, and so on. So it's not an especially fast way of conducting business. Well, it has transaction cost. You can lose it. We've all of us have lost money at some point for stupid reason, like you forgot your wallet or you drop a bill. So there are transaction costs. You need to carry them around. That's also a transaction cost. It's costly to produce. Yeah, it's not free, and the central bank has to produce those bills. Typically, they ask some external company to do it, but still they have to pay for it. And finally, there's a risk of counterfeiting, right? Fake bills, fake banknotes. It's a real risk, right? Especially in the US, where they're still using paper money. There's a lot of security embedded in the bills, but still, I think in Vietnam you have polymer bills. Am I correct? Yeah, as far as I remember, at least the big bills, the larger bills, they are polymer. Yes. So thank you. So they are not that easy to counterfeit. They are more difficult to counterfeit, obviously, because the material is not as easy to get. It's easier to embed some security devices in it. But in the US, at least the lower denomination, they're really basic stuff. Right? Even in Europe, it's also paper. I know in Australia they're using polymer. I think in New Zealand as well, Vietnam. All right, so those are the drawbacks or the issues associated with using cash. Okay, let's have a look at the electronic money. What do you mean electronic money? That means the money on your account. Right? When you log in on your phone or your computer, you can check your balance, and you have some money available. That money, sitting on the deposit side of the bank, right? Deposit right there. That's the money that you have on your electronic account, which is a liability for the bank. Never forget this. Okay? Electronic money. Here are the problems. A middleman is needed to verify that you have the resources. Yes, that's the whole point of the bank, right? It's checking. When you want to make a payment, it's going to check first that you have the money. You're going to see with Bitcoins that you don't need a middleman, because if you're part of the Bitcoin network, it's the entire network that checks nearly in real time that you do have the resources. Whereas if you do a payment in the current system, first the bank has to check that you have the resources, and then it's going to go through the interbank payment system. Okay, so that's what I need by that. There's a middleman, the bank, the payment system that is needed to verify that you have the resources. And there are various problems associated with that. One of them is privacy concern. And in the bank, I can tell you that your banker knows a lot about you. Perhaps they know more about you than your husband does. Because just looking at your bank account, they know exactly the sort of life you're living, right? Where you eat, where you sleep, where you go on holiday, how much you spend on clothes, everything. Hmm? Well, is that a good thing? I'm not sure, right? There are some privacy concerns. I personally don't like the idea that someone I don't know knows so much about my own personal life. Okay? Not that I have anything to hide, it's just a principle. Okay? Freedom and privacy. So I don't like this very much. Most bankers are very nice people. They're very honest, but still, you never know. Third problem, the payment system or the banks can freeze your accounts and confiscate your money. Yes, I mean, let me draw that again. This is a liability for the bank. So if they decide, well, I'm not going to give you your money, what can you do? Okay, there's nothing you can do. And let me tell you a story about that. It's in Cyprus. Do you know where Cyprus is? It's an island of Turkey. It's in the Mediterranean Sea, in the south of Turkey. Half of it is independent, and the other half belongs to Turkey because Turkey invaded it back in the 1970s, I think. So there was a financial crisis in Cyprus in 2011, 2012, and they decided that they would tax every deposit above 100,000 euros, just to prop up the financial system, to refinance, to provide some cash to the financial system. So can you imagine that? So you have an account in Cyprus, you have like, I don't know, let's say 200,000 euros. And because the banking system is in trouble, they're going to say, all right, I'm going to tax at 50%, half of anything you have above 100. So that means they're going to take 50. So you're down to 150. Oops. Just like that, because they decided, well, we're going to take your cash, sir. Is that because we need to refinance the banking system? I'm just using an example here. If you have a 200,000 account in Cyprus and they decide to implement the 50% tax on everything above 100,000, they're going to take half of it, so that's 50,000. And there's nothing you can do unless you remove everything in cash, but good luck asking your bank to remove 250 euros in cash. You can try to transfer it to a foreign country, but they're going to implement capital control to prevent you from doing it. Most people would not like this, obviously, but most people would not even understand that it's a completely fake measure. Why? Because we know, I'm going to write that here, we know that the central bank could have provided that liquidity instead. You know that, we know that. The ECB, I think for Cyprus, the ECB could have provided that liquidity. So why is that suddenly they're asking for this tax? It doesn't make any sense, right? Well, it does make sense, but it's all political. It's about saying we're not going to print more money. We're just going to tax some people's accounts. My point is, this is possible. They've done it in the past, so they're going to do it again. They've done it for Cyprus. Okay. When I say, by the way, why don't they create the money that they need? We know central banks can do. This is what I've just written here. Okay. We know central bank can expand their balance sheet at will. Why is that suddenly they decide to tax people instead? This is all political. Okay. I thought that someone was writing or typing. So if there is a question, I'm happy to take it. All right, no question. So let's move on. So you see, we've looked at the problems of cash, the problems of electronic money. Now, one last issue with both cash and electronic money is something that we know: excessive money printing by the government dilutes the value of your money. Okay, I'm not going to come back on this. So, how does Bitcoin enter the picture? Well, you're going to see that Bitcoin solves a lot of those issues. Which ones? I'm going to try to highlight that. You don't need face-to-face meeting with Bitcoins. It's pretty fast. Well, there are some transaction costs. I'm not gonna. It's costly to produce. Yes, you need some electricity. Very difficult or impossible to counterfeit. So this all goes away. There's no middleman needed because it's a network. Privacy. It's hard to say. There's more privacy with Bitcoin, that's for sure. So but it's not fully anonymous. So I'm gonna cross it only halfway. Okay. If you want a more fully anonymous cryptocurrency, you need to use Monero, for instance. Monero, it's a fully anonymous cryptocurrency. With Bitcoin, you cannot be taxed by the government. They cannot take your money away. Aha. Now you understand why they don't like Bitcoins, right? They cannot take it from you. Not only that, but it's kind of shaking the whole banking system on its feet, right? Because it provides an alternative that is safe, that is private, that is secure. It has its problem. We're going to talk about the weaknesses of Bitcoin, but at least you can see among the 5 plus 3, that's 8 problem, it solves 3, 4, 5, 5.5. That's pretty good. That's pretty good. It has some other problems. We're going to talk about that. All right, so what is Bitcoin? So Bitcoin is an electronic encrypted. This is important because it's different from electronic money. When your money on your account is not really encrypted, right? You don't need some sophisticated algorithm to understand what that how much you have on your account. You just log in and there it is. And in particular, all transactions are heavily encrypted and protected. So a Bitcoin is an electronic encrypted money with a decentralized. That's the most important word. So I'm going to cycle it again and again and again. It's a decentralized system. Okay. Peer-to-peer means person-to-person system of processing and recording transactions in a publicly distributed ledger. That's another important word, sorry. A ledger book. It's like a huge book in which you would record every single transaction that has been conducted with Bitcoin from the very beginning of that particular Bitcoin that you use. Okay, so it's like a history book. A ledger is like a history book. Huge electronic history book that keeps track of every single action, every single past transactions with all existing. Pretty amazing, right? That's what a ledger is. I'm going to shift to red because this is not easy to read. So peer-to-peer means the Bitcoin user community, rather than banks, is actively working on checking and validating and keeping memory of all transactions since the beginning of Bitcoin in 2008, 2009. Okay? The transactions are verified by a network of computer nodes and are recorded in a publicly distributed ledger called the blockchain. It's this big history book I was talking about is actually the blockchain. Why blockchain? I'm going to talk about that because we add every 10 minutes when additional transactions using Bitcoin are registered. This creates a new block of transaction that is added to the chain of block. So that's why we call it the blockchain. Okay. So Bitcoin is not like current electronic money since no central party is involved. That's very important. Okay. But it's not like cash either because it does not involve the exchange of a physical object. Okay. So it's a bit of a weird animal. So I'm gonna move forward a little bit more and then I'm gonna stop to some drawings. So there's a simple analogy. Perhaps I'm gonna do those drawings right now. I'm gonna move to the blank presentation, and I'm gonna make. So I'm gonna talk about the regular banking system. Today's regular banking system. How does it work? Well, first of all, have a big fat central bank at the center. Okay? And then we have a bunch of small banks, of commercial banks around. Okay, those are commercial banks. All right, this is all commercial banks. All right, so we have central bank. And we have commercial banks. Okay, and then we have Customers. I'm going to put the customers in blue, just like this. So all little customers, right? Fat customers, big customers, tall customers, bunch of customers. Okay, and those customers, they make payments. Okay? And they're, or rather they're banking with one particular bank, right? Like this. Okay, they may have different banks, not necessarily an issue. Right? This guy is banking here, he's also banking here, etc., etc. Okay, and when they want to make payments, uh, they can use cash, but if they do electronic payment, then those payment has to be processed through the banking system. Okay, we see that that's the interbank payment, right? So the green line here corresponds to interbank payments. That's up to 3 p.m. Okay, we know that after 3 p.m. you naughty boys in Vietnam are doing some free banking. Ah, this is free banking. I'm going to put that in quotation mark because it's not exactly free banking, but it, you know what I mean. It's using the Nostro and Vostro account. Free banking. But my point is, every single transaction goes first to the bank, then to the central bank, then back to the bank, then back to you. Okay, so it's all very centralized, right? It is all very centralized. It is all very centralized. Comment. Can we consider free banking as bilateral multilateral banking connection? I'd like to think yes. I think that would be one way of looking at it. Yes, it's doing away with the central bank in a sense, right? It's doing your own business without the central bank. So you open account to each other. So bilateral multilateral banking, I like the idea. Yes, that's one way of saying it. So you see, today's banking system is very centralized. Okay, every time unless you use cash, and if you use cash, there would be some sort of like this, right, between customers. But unless you use cash, if you use electronic money, it goes first to your bank, then it's processed to the central bank. They make this interbank payment, and back to your bank, back to you, and back to the guy you bought from, and to his or her account. Okay, so it's very centralized. I would like to represent what Bitcoin is. Aha! But Bitcoin is working this way. So you have a bunch of computer nodes that are running the Bitcoin system. Okay, it's not every computer. It's only computers that have installed a particular software that can run the Bitcoin program and the Bitcoin transaction processing algorithm. Okay, so all those blue squares are computers somewhere on this planet, and you have a lot of them, right? That are processing and registering the transactions in Bitcoin. And the pink circle are the customers, the people using Bitcoins, right? And you have everywhere customers with Bitcoins. And they are all, so all these nodes, all these computers they are all related to each other, obviously, because through internet, right? So they're all related to each other, and in particular, they're all checking at the same time that they have the same information, right? For instance, well, let me relate them together first, like that. Okay. So the customers, they sometimes they're trading. Oh, I'm gonna make a Bitcoin purchase. I'm not gonna use black because we don't see it. Perhaps green. I'm gonna make a purchase with my Bitcoin. So suddenly, because once you've entered the Bitcoin network, you can see that all computers are related. So your purchase using a Bitcoin is being replicated, transmitted to the entire network of computers using Bitcoin. And because other customers are related to this network, they are also informed that you have spent 1 Bitcoin. Okay. Of course, they do not receive an alert on their a notification on their phone. It's just, but the whole network has recorded this transaction. Okay, so as you can see, by contrast to the current banking system, so here this is the Bitcoin network. It is all very decentralized. Decentralized, right? There is no central authority. If you look at that, everything goes through the central bank, right? Here, there is no central authority processing the transaction. It's a decentralized network computer that has to agree. And that's an interesting part of it. Because if this computer, for instance, says, wait a minute, I do not agree with this transaction that this guy is trying to do here because he claims he has Bitcoin, but I can tell you he doesn't have. So he's going to spread this information to the other one. The other one's going to verify and say, oh, you're right. He doesn't have the Bitcoin, so he cannot do it. Okay. So my point is that they all have to agree at the same time, roughly at the same time, that this transaction can move forward. He wants to spend the Bitcoin. He has the Bitcoin, so that's okay. Okay. So it's completely decentralized. Okay. So that's, you can already see that in terms security, in terms of privacy, in terms of theft, it's much more difficult, right? Because it's all electronic, and every time someone's going to try to mess up with the system by trying, for instance, to manufacture fake bitcoins, the whole network's going to ring. Burp, burp, burp. Something's wrong going on. Someone is trying to do bad. Okay. Whereas in this system, well, of course, it's hard to do bad because you're going to be checked by your bank and the central bank. But the central bank can do bad in a sense, right? I mean, what the Fed has done and printing all this money, and in Europe as well, in a sense, it's bad policy. Right? There's nothing that can be done in the Bitcoin network. Okay, so keep that in mind. I'm going to move back to the slide. Keep presenting you the Bitcoin technology. So I'm gonna cover, let me see, perhaps a couple more slides and we're gonna do a break. So a simple analogy is the Yap Island money. I told you about that already. It's a community, the Yap, you remember those Bitcoins we talked about in the first class? I told you they don't move, right? Because people remember that this coin right here belongs to Mr. Smith. And that coin belongs to Mr. Thompson, right? And that coin belongs to, I don't know, someone else, right? So they don't move around. Well, so it's kind of a memory, right? Those big coins, they work as a memory. memory system. Bitcoin is the same, right? There is no physical exchange of any item or object. It's just the property of one Bitcoin is allocated to someone else on that big network that I've just shown you. So Bitcoin is like memory, right? It's not cash. It's clearly not cash because there's no exchange of the Bitcoin system. Cash is a substitute for memory. You remember that, right? If you have cash, that means you work at some point. But another way of storing this information that you worked at some point, you can store it electronically through Bitcoin. So that's why Bitcoin is an advanced version, in a sense, of the Yap Island money, only with today's technology and impenetrable, highly sophisticated cryptographic techniques preventing fraud, thereby making it accessible to communities larger than an island. Yes, because Yap Island money was working on the island because it's a small island, so you can make it common knowledge whose coin it is, right? But you cannot do that for the world economy in its entirety. It's just too big. People will not remember who owns what and so on and so forth. So, but you can store that information electronically, and that's precisely what Bitcoin is all about. Okay. So that's why we say money is memory, and that's why we say that Bitcoin is some sort of advanced memory technology. As we will see, the key really is encrypted public memory about ownership. Encrypted, it's important because you don't want anyone to be messing with your memory, okay, with the memory. I think there's a movie, a science fiction movie about this when perhaps with Leonardo DiCaprio, in which you have those people they can alter someone else's memory. Yes, that's right. I haven't seen this movie. I've been told it's a good one, so I might have Inception. Thank you. That's exactly that. Do you recommend that I watch this movie? Yes. Okay. So I might do that. I love science fiction movie, but I never watched that one. So, but I've been told that's the story, right? They're changing everyone's. They can change people's memory inside. So with Bitcoin, you don't want people to be able to do that, right? Because then that's going to be a big mess. People all over the place claiming this is my Bitcoin, no, this is mine. So that's why it's encrypted, because this big network of electronic memory, you don't want people to be messing around with it, right? So, and in particular, if there is a sale, the public memory, that is the blockchain, needs to be updated. That's why we say that money is memory. I hope I convinced you that somehow money is memory. All right. Uh, this is slightly involved to explain, so I think we're going to make a break now. As I told you, because today we had two classes, we're going to make a 5 minutes break a bit longer. We're going to make it a 10-minute break. And when we reconvene at 30, I'm going to explain to you this encryption mechanism and how it works. All right. So see you in 10 minutes. All right, welcome back. So, um, so Bitcoin. So Bitcoin, as I said, it's a network of decentralized computers that are processing in real time and checking all the transactions currently being realized, as well as the past history of those transactions. It works in a decentralized way, and it works by adding information about the new transactions to the existing information about past transactions. And every time you add a new transaction, you add a new block to that history, and those blocks are chained to each other in a sense that what happens in block n plus 1 depends on what happened obviously in block n, in the sense that what can be spent in terms of Bitcoin in block n plus 1 depends on what was available at the previous period. So those blocks are related to each other, right, for consistency. That's why we call it a chain, right? And because you have many blocks, we call it a blockchain. Okay. I told you one important aspect of blockchain is encryption, because you don't want anyone to be messing with the memory of who owns what in terms of Bitcoin, just like in Inception movie. So I'm going to talk a little bit about that and the algorithm. The algorithm at the heart of the Bitcoin technology. Okay, so let's start with the two principles regarding Bitcoin. First of all, the electronic signature, right, and the public ledger. We talk a bit about that already. So electronic signature uses asymmetric encryption. What does that mean? Upon signing in your Bitcoin account, you will be given two keys, a private key and a public key. They are created and given to you. Those keys are two random numbers of lengths 256, I think. The private key is used to encrypt transactions order, right? So your private key is sort of your bank account number, and it's private. Okay. The public key is used by everybody to decrypt your payment transfer instructions. And somehow your public key is also your address on the network. So you see two keys, one private, one public, one to encode your own transaction and one to decode the other transaction. The payment instruction also contains information about where those bitcoins are coming from. Yes, I told you, each bitcoin has a history, right? Uh, this is one bitcoin, right? Uh, then it moved there to buy some stuff. So there's a history. We can trace that bitcoin. Then it moved there, then it went back there, then here. So is somehow the history of Bitcoin. Okay. How it moved on the network and in terms of ownership, right? So the payment. So what I'm saying is that this Bitcoin here contains information about everything it did in the past, right? So you can move backward uh, and figure out everything that was done with its Bitcoin. It's possible, right? No, nobody does that, but it's possible, and it's what I mean. Let me put it another way. Everybody does that without realizing it, right? It's the point of the whole Bitcoin network, right? To do some sort of backward checking that everything is consistent. Okay. So the payment instruction also contains information about where those bitcoins are coming from. That is their history. This allows checking that those bitcoins have not been spent already, right? Okay. So the last transactions in Bitcoin are processed every 10 minutes on the network. So it's not live actually, it's every 10 minutes. Some people have complained about this, and you have a lot of new tech companies that are working on speeding the blockchain technology, which at the moment is considered a bit slow. I'm sure one day we'll move to something instantaneous and live, but at the moment it's every 10 minutes. So what does that mean? That means transactions are queuing. Okay, there's some sort of queue, and every 10 minutes all the transactions in the queue are processed. Okay, if they are valid transactions, they will be confirmed and stamped as valid transactions. If they are not, they will be rejected. Okay? And all those validated transactions are then encrypted in a new block that is added to the blockchain. Okay? All nodes of computers in the network. So how does it work? So you see, you have this queue of transactions. Okay, that the queue grows, and then after 10 minutes, it's processed. So all computers in the network receive a list of transactions, those transactions that have been queuing, waiting to be validated, processed, and recorded on the blockchain. Okay. Once this is done, those transactions are given an identification number or a stamp, right? Just like on the coin. Remember, we were stamping the coins. And it's somehow the same but electronic. It's validating the transactions. So the validated transactions add a new block to the chain of blocks. That's why we call it the blockchain. Okay. The first computers or node of computers, node means a group of computers, to come up with the required identification number for this new block earns a prize. And that's something very important to understand in Bitcoin. There is every 10 minutes, there is a competition that is organized between all the computers in the network to be the first one to validate and stamp this or reject these new transactions. Okay, every 10 minutes, all the computers in the network are put into competition to be the first one to validate this transaction according to some criteria that I'm going to explain in a minute. And if you're the first computer or group of computers to do that, then you win the prize. And the prize is some Bitcoins. Okay? I think at the moment it's 12.5, or it might be 6.25. I'm going to give you that information in a moment. But I think Bitcoin at the moment is pretty expensive, right? Let me check that. CoinDesk. Oopsie, 17,000. So at the moment, one Bitcoin is 17,000 USD, roughly. Okay, so if you win like, I can look at that right now. Where do I have this information? Here it is. Let me see. Bitcoin mining price. Since February 2019, one block reward was worth 12.5 Bitcoin. Okay, so 12.5. So 12.5 Bitcoin is the price for being the first to validate the transactions and add them to the blockchain. Okay, so that means 12.5 times 17,000. That's about $212 every 10 minutes worth of Bitcoin that is being distributed within the network. So let me summarize what I've just said. So you have the candidate, let's call them the candidate transactions. Candidate in the sense that they haven't been validated yet. They are accumulating in the queue. After 10 minutes, we close the queue. All these transactions are being thrown into the network, and the computers go into a competition to be the first to validate those transactions. And the first computer to come up with be able to validate it, and I'm going to explain in a moment how it does that, wins the prize. And the prize is about 200,000 US dollars a month every 10 minutes. Okay. So why do we need to have all this competition? Okay, it's what we call proof of work. It's a reward for taking part into the system. Okay, you need to have incentives to run the Bitcoin technology. Okay, if people were not rewarded for running huge sets of huge groups of computers, look at that. This is a mining farm in Iceland, right? Those are all Bitcoin specialized computers that are running the Bitcoin algorithm in order to have a chance to be the first one to win the Bitcoin. Okay, that's pretty amazing. So you see, that's costing a lot of money. We'll talk about that. So people are not going to do this for free. They will do it if they expect a return, and the return is the Bitcoin price. I was talking about those 12.5 Bitcoins. Okay, and but you don't want to allocate the price randomly, right? You want to allocate the price to someone that has been working hard to make sure that the algorithm is working well. So how does it work? So validating the transactions, the candidate transactions in the queue means giving them the proper coin goal identification number, which we're going to call ID. All right. How is this ID being produced? How is this ID number being produced? Well, it works in the following way. That identification number is produced by an algorithm that takes into account three inputs. First, the ID number of the previous block. That's your input, number one. Input number two, the current transactions waiting to be added to the blockchain. So that's the group of transactions waiting in the queue. That's the input number two. Okay. And finally, a random number, which we called a nonce. Okay. All this information goes through. So all the three inputs, 1, 2, 3, they go into what we call a hashing function, which is a function run on a computer that turns all these three inputs into a sequence of number of a fixed size, for instance, 30 characters. And that's the identification number. Okay, but the produced number must meet a certain number of criteria that require huge computing power. For instance, the 30 character number must have perhaps 4 zeros at row 10 and have 2 7 and start with an H or whatever. This sort of requirement that is produced by the Bitcoin algorithm. Okay, and unless you meet this criteria, your produced identification number is not correct, is not valid. Okay, but because part one is fixed and part two is fixed as well, it's just the random number that changes. All those computers, they need to run a very, 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 and by very, I mean very large number of random numbers in order to finally produce uh, the correct identification number. Okay, so you need to try a very large number of nonces to finally find a unique identification number that matches the required criteria. Okay, so I'm going to make a picture of that to make sure that this is clear in your mind. Perhaps I'm going to read a bit the beginning of the next slide. The requirement on the produced identification number are so demanding, for instance, 10 zeros following each other in an even larger sequence of characters, that it takes a lot of computing power. Okay, and this procedure is vital for the working of the system and to protect it from people trying to forge false bitcoins. I'm going to shift back to the blank presentation and try to show you a little bit how this works. Okay, so I'm going to use another blank slide. Oops, a blank slide. That's balance sheet everywhere. I have a blank slide, please. Yes, here you got one. All right, so first input. That's what we called the ID number of the previous block. Okay, ID number of previous block. All right, that's input number one. Input number two is the transactions waiting to be validated. Remember that? Transactions waiting to be validated. All that is fixed, right? Every 10 minutes, this doesn't change. Okay, you have the ID number for block n-1. Okay, let's be very explicit and say our previous block, which we're gonna call the block n-1. You have the transactions waiting to be validated for block n. And then you have the third input, which this time I'm going to put in red to emphasize the fact that this is random, or this is not fixed. And we're going to call that, which is a nonce, right? Nonce, which actually means a random number. Okay. All this will go into a hashing function. Oops. I'm going to put a cycle for change. Okay. This is a hashing function. Okay. And this will produce, so this goes this, all the inputs enter this stuff. And it's going to produce candidate I'm going to put that in red to emphasize the fact that it's changing with every nonce. Candidate identification number. Candidate ID number for block n. Okay. Now the question is, let's change the color, perhaps green. Does it match? Does it match the required criteria? Okay. Options. If it does, and if it doesn't. So here we have yes, no. If it's no, then that means you're gonna go back like this to the random number. Okay, and you try another one. Okay, it goes through the hashing function. It gives you a candidate ID number for block n. Does it match the required criteria? No. Then you start again, and that we're talking trillions of numbers, right? Trillions. So it's amazing. And then suddenly, bang, that's the correct one. Oh, it matches all the criteria. That is, you have this very large sequence of numbers that you wanted H in the front, you wanted 2 zeros, you wanted 7 twos, and whatever criteria, right? Then if it's a yes, then what happens is that block block n, oops, this and like this, block n transactions are validated. Okay. Time to look block n plus 1. Okay, and the guy, the computer who found the right nonce wins the 12.5 bitcoins. Okay, so this algorithm is embedded into the Bitcoin technology to make sure that there is a reward for people that take part into the Bitcoin community by making it run. You need to understand that if there was nobody taking care of this stuff, then there would be no interest. The system would not be working. But to make sure there is some incentive to run this sort of heavy computing machinery, you need to reward people that are taking place. This is called also proof of work. Okay. To be rewarded with Bitcoin, you need to have proven that you have worked for the system. Okay. And how can you show that you have worked for the system? But simply by running computers to run the Bitcoin technology, to take part into the Bitcoin technology. Okay, so I'm going to move back to the main slides. That's this one, and read the slides. So the requirements on the produced identification number are so demanding. So you remember the criteria I was talking about, right? They are very demanding. They're very difficult. So you need to try a very large number of nonces, of random numbers, to eventually find the one such that this hashing function will produce the right identification number. Okay. Now this procedure that I've just shown you is vital for the working of the system to protect it from trying to forge false Bitcoin, right? Because to forge false Bitcoin, you would have to have the computing power that is big enough to be able to twist, to influence all the past history. That's just impossible, right? Because it is a hard job. If you succeed, you get rewarded with 12.5 bitcoins. each worth, oh my goodness, look at that. Last year when I did this class, it's amazing. When I did this class last year, it was worth $1,180, and now it's 17. So it's been multiplied by like 15 or something. That was a good investment. But it has a lot of ups and downs with Bitcoins, right? You know that. I'm going to show you. I'm going to do it right now. I'm going to show you the price history of Bitcoin. You're going to see it's pretty hectic. So let me share my screen. So this is the Bitcoin price, and it doesn't even start. It started back in 2008. It was zero for days and days and days, zero, zero, zero. Then it went a bit up, hundreds or some time, and then it completely exploded to reach 19 in 2018. You can see. Oops. There you go. 2020, and then it crashed. Went to 3,000. That's funny. That doesn't look like a right number, what I said in July. So July. No, there's a zero missing. Sorry. If you look at July 20, yeah, it was not 1,000, it was 11,000. So I'm gonna correct that right now. But perhaps we can stay a bit more there. As you can see, it went back up, and it's pretty close, if not higher than its 2018 heights, right? So very impressive. But there's a lot of ups and downs. That's my point, right? It's fluctuating a lot. That might change in the future. It's perhaps very speculative, not as liquid as we wish. But sure. Right. So I'm gonna cross that out because that's wrong. Oops. It's more like 11,000, right? Well, we don't care about the price of last year, do we? No, we don't. So, so the price of today is about 19 as of November 2020. Okay, so the requirement needed to be able to produce an identification number is called proof of work. Okay, and this activity, yeah, I'm going to answer your question. This activity itself is called mining. The fact that you are trying to win Bitcoin is called mining. Just like in the old days, when people were mining the silver and gold deposits in order to find gold and silver with some tools, a pick. Now we have some modern mining, but it's different in shape, right? It's about using computer to dig out Bitcoin that are embedded, buried somewhere in the Bitcoin algorithm. So interesting question. Who wins the prize? The Bitcoin miner. Where's the prize come from? So who wins the prize? The people that own the computers that was able to find the right identification number. Let me move back to the blank presentation. You see, all these computers, so they take the ID of the previous block n -1 as an input into the function. Then they take the transactions waiting to be validated for block n as another input. These two are fixed. That's why I've put them in black. And they add a nonce, which is a random number, and they put all this into this function. So this hashing function is pre-coded. Pre-coded in the Bitcoin algorithm, right? This all enters into the hashing function, and the hashing function spits out a candidate ID number for the next block n, okay? But this very large number has to meet some criteria. I told you about that. If it does not meet this criteria, then it moves back to the beginning, go back to 0, and you try another random number, okay? And all the computers taking part into the Bitcoin network around the world will try different nonces. But at some point, one number is going to be the right one. And therefore, that means that the transactions are validated, a new identification number is produced for the block n, and the reward is paid to the people who own the computers that came up with this nonce, with the correct nonce. Okay. Who grants the price? It's the algorithm. Like if you're part of the blockchain network, that means you already have a Bitcoin. Sorry, if you're part of the Bitcoin network, that means you already have a Bitcoin portfolio. Okay, so if your computers are taking part into this process of mining, and if you win the prize, then the algorithm is going to hand you 12.5 bitcoins in your Bitcoin portfolio. Okay, it's nobody. There's no physical person that gives you the Bitcoin and a bunch of flowers. It doesn't work this way. It's just bang. Your portfolio account, which has been running on the decentralized network, that guy, right? So for instance, assume which color I'm going to take. Orange. Assume this computer was the first one to come up with the right random number and therefore the right identification number. So he's going to get the 12.5 bitcoins, right? But on his portfolio of Bitcoin, and this is allocated, this is given by the algorithm, not by anybody. You see, it's very different. It's just like if your bank suddenly credits your account with 10,000 US dollars. So this is an electronic action. Well, that would be the same, right? And where does the price come from? It comes from the algorithm, right? So the Bitcoin source is never end. I'm going to talk about this. That's the next slide. So let me move back to it will end. It will end. Only to exactly. So perhaps it's a good time to move to the next slide. So the new identification number attached to the latest transaction will then be used as an input into, you're welcome, into the next processing and stamping of the next transaction. Yes, keep in mind, it's never ending up until we go to this 21 million Bitcoin. But until we are there, if we go back to 7, 8, once the block n ID number has been produced, then it becomes the input for the next block, and the transactions waiting validated for block n plus 1, and then the whole thing starts over. Okay, random number, blah, 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 very large number, bang, you got the right one. The n plus 1 block is validated, we move to n plus 2, and so on. And every time we add a block to the blockchain. Okay, for instance, like this. So you had the first block of transactions with the first block of transactions with Bitcoin, then the second one, then the third one, and then etc., 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 etc. And then today we are at block, whatever. Okay, that's block one, block two, block three, block n. Okay, and this whole thing, this is a blockchain. Okay. Right. Let me move back to the main presentation. Okay. So that new ID number attached to the latest transaction will then be used as an input into the next processing and stamping of the next transaction 10 minutes later, etc. That is why it is a chain, the blockchain. This procedure prevents the changing of past transactions as it would mess up all the following identification number. It therefore prevents forging false Bitcoin. Because if you want to manufacture false Bitcoin, you need to change the entire history of the blockchain. I guess in theory it is possible. I've read about this. In theory it's possible, but you need a massive computing power in order to enforce, by force in a sense, a different story, a different history of Bitcoin, right? And I think some of the other cryptocurrency that we have, like Bitcoin Cash, I think it's what we called a fork in the blockchain, in which at some point there was some conflicting history about the history of Bitcoin, the past transaction, something like this. So suddenly there's a fork, what we call a fork, just fork, which you have two competing stories. So you have like the traditional Bitcoin history, and then suddenly you have a fork like this. As time moves forward, like if we move in this direction. Okay, so this is the history of Bitcoin, and then suddenly, bang, there's a fork. There's two competing histories. Interesting. All right, but this is very rare, right? This is very rare. Fun facts about Bitcoin. They're a bit old, but they're still interesting. To work the system back in 2016 required the electricity consumption of about 135 US households. A lot. Between March 2014 and March 2015, the average number of nonces, remember those nonces? That's the random numbers that the miners are trying. They had to try before creating a new block increased from 60 quintillion to 200 quintillion. So that's 10 to the power 30, and I don't want to even try to draw this. That's just too big. That's the number of random numbers they have to try before coming up with the right random number that would produce, so this guy here, that would produce the right identification number, and means that's a yes here. Okay, quintillions. So that's a lot of zeros. All right, and we still don't know who invented it. This Bitcoin algorithm. His name is, I think it's an alias, so it's not his real name. Is Satoshi Nakamoto. Some other fun facts about Bitcoin. I read a lot of funny stories. When it was created back in 2008 or 2010, 9, Bitcoins was really worth not much. It was really worth nothing. So people did not were not very careful with that. It was a, I mean, like I'm going to say a random number, but perhaps like 1,000 Bitcoin were worth $1, something like this. So it was really worth nothing. So people were careless. Some people bought pizzas with by spending I don't know maybe 20,000 Bitcoin just to buy one pizza. Now with 20,000 Bitcoin, I would be a millionaire, right? So it's crazy. Yeah, we have stories about people losing their private key. So they have a big, massive Bitcoin portfolio from the old days with perhaps thousands of Bitcoin sitting there, but because they've lost the private key, there is no way they can access those Bitcoins, right? So this is crazy. Uh, so let's move forward. So this is a mining farm in Iceland. So as I told you, because when we're talking quintillions of random numbers to try, you need a lot of computing power. This is a lot of computing power. And by the way, because the electricity consumption of mining farm is huge, typically those mining farms will be located in countries where electricity is cheap. And you may not know that, but in Iceland, electricity is cheap. I think people don't even pay it. Why? Because 90% of electricity production in Iceland is geothermal, which means coming from volcanoes. So it's pretty cheap to use, right? So you have a lot of mining farm in Iceland. You also have a lot in China. Why is that? Also because electricity is cheap, but in China it's because electricity is produced by coal-fired power plant. That's good, right? Because it's highly polluting. It is dirty, right? But it's still cheap. So that's why you have a lot of mining farms in China. Let's have a look where they are located nowadays. So mining Bitcoin mining farms locations. I want some map. I like maps. We have a map here. Oops, 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 oops. Mm, oh, yeah. I'm trying to find a map. There we go. A list of the biggest Bitcoin. Hopefully, it's not too old. So I'm going to. Yes, that's 2020. Good. So I'm going to share my screen with you so that you can see where those Bitcoin mining farms. All right. Yeah, there you go. So as you can see, uh, China, you have in Thailand, Hong Kong, Georgia, Iceland, as I told you, Northern Europe, North America, some in Venezuela, and then you have by consumption in terms of electricity. So here we're talking megawatts. So the darker, like the big ones, they are in Georgia, in China. Then smaller ones in Canada and the US, and even smaller one in Northern Europe and Iceland, and then small ones in Thailand, Hong Kong, and Venezuela. Okay, as you can see, you have a lot in China as well. A lot of mining farms. All right. Okay. I have some question here. What is a block halving event? As part of Bitcoin's issuance, miners are rewarded a certain amount of Bitcoins whenever a block is produced, approximately 10 minutes. Right? When Bitcoin first started, 50 Bitcoin per block were given as reward to miners. That's right. After every 210,000 blocks are mined, approximately every 4 years, the block reward halves and will keep on halving until the block reward per block becomes zero exactly. As of now, the block reward is 6.25. Huh. Yeah, maybe it's half what it used to be, and will decrease to 3 point very soon. Thank you for posting this. Thank you. I'm gonna move to the finish the slide, and I'm happy to take questions and comments. So let's stop. I would like to share with everyone the award prize information. Yes, thank you very much. That's a good idea. Please do not hesitate to use the public chat to share information. That's very useful. So thank you. So what are the weaknesses of Bitcoin? I very much like the idea of Bitcoin, but there are some weaknesses. Here is one. If you lose your private key, you're done. That's the end of it. I told you that story, right? About those guys that had Bitcoins in the early days. They cannot access them anymore. If you lose your credit card, or you don't lose your money, you just call the bank and say, well, I lost my card, and they're going to make a new one for you. Okay? With Bitcoin, that doesn't work this way. Second one, it can be used for criminal activities because there's some sort of anonymity, but it's not full anonymity. Okay? It's always possible to move backwards and to recover the identity of people. It's not a fully anonymous cryptocurrency. I told you there are some that are like such as Monero. There are a few others that are fully anonymous. I don't like this criticism very much. Why is that? Because as you will realize, criminals did not wait for bitcoins to be criminals, right? There's always been crime in the world way before cryptocurrencies existed. So I think it's a fake criticism. So I'm going to cross that out. I just want to mention it because you hear people saying that. Usually, people that complain about bitcoins are somehow related to the central bank, I guess, right? Because you can see that Bitcoin is a big threat to that monetary system that we have described so far in this class, right? It's really a completely different animal. It's decentralized, it's private, it's encrypted, it's impossible to cheat or to manufacture false bitcoins. It's really, really different, right? And it would bring some sanity, some seriousness, some security into the monetary system. So I think it's an extremely interesting and positive development. But obviously, central banks don't see it this way. They see it as a threat. So perhaps you don't have this problem in Vietnam, but in the West, many of our media and newspaper and TV channels they tend to repeat the official language from the government, and that would be saying that all the Bitcoin is bad and government money is good. Well, I don't think so. There are some problems with Bitcoin. We're all aware of that, but that's not. Again, if you're an economist, and I'm sure you are, you have to compare the benefits. I'll answer your question in a moment. I want to finish this about Bitcoin. Let me see how many slides we have left. We have two. That's okay. Fractional reserve banking is not possible. Yes, fraction. By fractional reserve banking, I mean the following. your reserves here are only a fraction of your deposit. I mean, we have the deposits here, we have the reserves here. We have the loans, for instance, right? That's what I mean by fractional. Fractional in the sense that it's just a fraction. And what is this fraction equal to in Vietnam? What is the reserve requirement ratio in Vietnam? Thank you. That's right. So you have only between 3 and 10% of the deposit that are backed by reserve. That's what I mean by fractional reserve. Okay. So I've criticized fractional reserve banking. Yes and no. But one very positive aspect of fractional banking is that you're not, as a bank, you're not constrained by the amount of reserves with regards to the amount of loans that you can make, right? There's some flexibility, there's the money multiplier going on. So what I'm trying to say that a bank can always create money whenever it uh, thinks it is appropriate. So if a customer walks in, asks for a loan, and it looks like it's the bank's going to be making money on that loan, then the bank will say yes. So the bank is not constrained. It has to hold some reserve, that's right, but it worst case scenario, it's going to pay for those reserves, right? With Bitcoin, it's not going to work this way in the sense that one Bitcoin is one Bitcoin. So it's 100% banking in a sense. You see, you cannot create Bitcoin out of nowhere. Whereas we know that commercial banks can do that with their own private money. Every time they make a loan, they create their own money. We know that central banks can do that as well. They can issue base money at will. You cannot do that with Bitcoins, right? You have Bitcoins that are produced every 10 minutes. So now it's six. So I told you it's 12.5. It looks like this has been halved recently to 6.6. Oops, to 6.25. So you have 6.25 Bitcoins that are produced every 10 minutes, and that's it. No more than that. So that's what I mean by fractional reserve banking is not possible in the sense that you cannot lend Bitcoins that do not exist yet. That's another way of saying it. I'm going to write that here. You cannot lend Bitcoins that do not exist yet. Okay? Whereas you can lend loans that do not exist. You got it. Good. The supply of Bitcoin will increase at a decreasing rate and will stabilize at 21 million Bitcoins. And the last block, as your colleague rightly pointed out, will be created in 120 years from now. So let me show you this graph. So the red curve here is the supply of Bitcoin, right? So it increases rapidly, and then it's going to plateau and reach and increase very, very, very little up until 2140. Here you have the number of Bitcoins that were rewarded to the first miners. As I told you, it was 50 Bitcoins. Then it dropped to 25, then to 12.5, then nowadays we're here at 6.25. Okay, and it's going to decrease, 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 decrease. But probably the price of Bitcoin will go up because there's a fixed supply and the demand keeps increasing. So even though Bitcoins are very expensive, there is a chance they might be way more expensive in the future. Just a quick point, I say it's deflationary. Why is that? Whoops. If bitcoins were the only source of money, it would be deflationary because there's a very slowly increasing supply of money, but the supply of goods and services would probably be increasing at a fixed or constant rate or whatever. So if you have uh, the supply of the GDP that grows like this and the money supply that grows like this, obviously the value of money is gonna go up, and the value of money going up means prices going down. So that's deflationary. Then banking no longer banking when the bank cannot make new money. Right? Yes, you're right. So that's one problem, that I see with cryptocurrencies right now is that the only cryptocurrencies that you can lend are cryptocurrencies that already exist. Right? You cannot lend non-existing cryptocurrencies. So that's what I meant by saying there's no fractional reserve banking. But the crypto industry is very creative, and I know a few firms in Switzerland, for instance, that are um, creating kind of fake assets that are backed by bitcoins, in the sense that Bitcoin would play the role that reserve money is playing in the banking system. So it would be like the reserve assets, and you would create like not fake but new assets that would be backed by Bitcoin, something like this. So there are ways to circumvent, I suppose, but you're right. You're right. Banking as we know it is not possible with Bitcoin technology, strictly speaking. Okay. So last slide for today. Yeah, I showed you that already. That's the 2019 October price, but I've shown you some more recent ones. So, all right. So I'm happy to take question. Bitcoin is not always easy. Can people do trading with Bitcoin like stock? Yes, they can. You go, for instance, as a CoinDesk. I'm sure you can buy crypto with that. A lot of website and companies offer to buy and sell crypto. So yeah, it's perfectly possible. You can even buy goods and services with Bitcoin. Some businesses allow you to do that. Not all of them. Some more and more probably. But the interesting thing to notice is that central banks are fighting very hard around the world to prevent Bitcoin and cryptocurrencies from progressing, because they can see there's a threat to their monopoly. Because there's not only Bitcoin. I talked about Bitcoin because it's the first one and the most famous one, but you have a lot of different ones. You have Ethereum, Zcoin, you have Monero, you have a lot of different cryptocurrencies. Is it possible that Bitcoin system collapse, hacked by somehow? I, um, I, I, I think technically it's possible. Um, you would have to ask someone who's really an expert on those issues. I think if it was hackable, it would already have been hacked by now. That would be my answer. Uh, in all cases, there's something to understand here. Hacking the Bitcoin algorithm is different from hacking into Bitcoin portfolio. Okay, the sort of stories you hear in the news is that some people somewhere lost Bitcoins because their portfolio was hacked. That's because of poor security on the side of the firms that is managing the Bitcoin portfolio, not the Bitcoin algorithm itself, right? This one is rock solid, and in particular, there is so much computing power that is involved in running the Bitcoin technology that it's very, very hard to come up with an alternative history, because I hope now you understand what it is. Bitcoin is about memory. It's about memory of past transactions. It's about keeping track of the history of all past transactions. So once you have written history, it's very hard to write a different history. Right? It's possible, uh, in theory, to go back in time or somehow. I don't know how it works exactly, and to rewrite the story of Bitcoin. And that would be a fork, the fork that I was talking about previously. But as I said, as I was saying, Bitcoin is not the only cryptocurrency. You have a lot of other cryptocurrencies. Some are perhaps even better from a technological point of view, in terms of protection, in terms of security, in terms of anonymity, in terms of speed as well, with which transactions are being processed. I told you every 10 minutes a bit slow. So yeah, that would be my answer. Got it. Thanks. You're welcome. Any other question? I can see that someone is typing, so I'm going to wait for that question or comment to show up in the chat. All right, if Bitcoins can be traded like a stock, banks can buy or sell, even short sell Bitcoins, so they can have Bitcoins to lend people that need. I suppose so. Yes, in theory, that's right. Uh, at this stage, though, I don't really see the point of borrowing Bitcoins unless you want to speculate on Bitcoins. But you're right. I'm sure some banks have cryptocurrencies trading departments, or at least a small team or small staff that is doing crypto trading. I'm sure of that. I guess it depends on the country, on the regulation, what's possible and what's not. So, yeah, it's becoming more and more liquid. So, by the way, I've read somewhere that perhaps like 6 or 10 years ago, 90% or 95% of the transactions with Bitcoin were speculative. And nowadays, this has fallen to like 60 or 70%. So, uh, a bigger and bigger share of, of Bitcoin trading is related to people actually using Bitcoin in day-to-day transactions for purchases. So, it's little by little becoming more popular and no, in case you treat Bitcoin as stock, it becomes a kind of asset commodity, not money. Eventually, there is no Bitcoin newly created for your lending service. Yes, you cannot lend Bitcoin that do not exist. Hmm? By contrast to the money that commercial banks are creating, right? Um, you can lend existing Bitcoins. If you have a Bitcoin, you can lend it to someone, but you cannot create Bitcoin out of nowhere, just like you can create money out of nowhere. Yeah, I get that. That's true. If what you're asking is whether we can use Bitcoin as base money, as the reserve asset for payment, probably not. I guess this is all about regulations, and that's, yeah, something that is also important, and perhaps that's going to be my last point for today, is that the future and the fate of Bitcoin very much depends on how countries are going to regulate the use of Bitcoins. Some countries are being nervous at the prospect of Bitcoin and cryptocurrencies becoming bigger and bigger, because for a lot of people, and including myself, would be very happy to move to cryptocurrencies as soon as it's a bit more stable. So that's one issue with cryptocurrency. Some countries are making the life of cryptocurrency very difficult by writing regulations here and there to prevent it from being used. And by contrast, some other countries like Switzerland, they're just saying, fine, do what you want. Happy if you use cryptocurrency. So it's something big to keep an eye on, is uh, how governments regulating the use and trading of cryptocurrencies. And by the way, that's going to be one topic of one of the group assignment. I told you about that, right? At least one of the topics is going to be on crypto. I'd like you to work on that. All right. Perhaps one last question. Right. It looks like there's no more question coming up. I guess we had a good full day, right? So we should not end ourselves too much and save it for Monday. Okay. So now it's time for me to thank you. A lot of participation today, a lot of questions. That was very good. So I hope you enjoyed and learned a bit. So our next class would be on Monday, and we're gonna have two more classes. Thank you. We're gonna have two more classes, Monday and Tuesday, and Monday is gonna be mostly class, and then I said Tuesday is gonna be half class, half practice exam. Okay, and a couple more exercises probably. All right, thank you very much, and I have a good Sunday, good end of weekend, and I see you on Monday.